We're in the midst of a global easing cycle, but a fast-moving Fed can open the door for that to be faster.
We do have a great soft landing scenario right now.
If you were to get a reacceleration in inflation, I think the Fed goes on hold.
Our base case is one more 50 and then back to 25s, but honestly, everything's on the table for this Fed.
The impact of the eases won't be known until the middle of next year.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Closing out Q3, welcome to Q4. Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now, following 5 straight months of gains, 4 consecutive quarterly gains on the S&P 500. Your scores as we kick off the final quarter of 2024 look like this. Equity futures on the S&P 500 down by about 0.1%. The Nasdaq up by 0.1%. The Russell is down 2. Our top story this morning, it's going to be market related at some point if this continues. Dock workers walking out of every major port on the US eastern Gulf Coast for the first time since 1977.
Just to put this into perspective, this potentially could affect half of all of U.S. trade volume. This is not insignificant. JP Morgan estimating the U.S. economic impact could be somewhere from $3.8 billion to $4.5 billion a day. We're talking about a pretty massive impact should it continue that carries exponential risks the longer it goes on.
Pretty powerful message coming from union leaders. We are prepared to fight for as long as necessary to stay out on strike for whatever period of time it takes.
2 sticking points, Jonathan, this comes down to. One is wages, and the other is the language around automation. We do know that the past 24 hours, there have been this back and forth regarding these negotiations. And this is what the United States Maritime Alliance came out with a press release. They said that their offer would increase wages by nearly 50%, though they did say it would retain the current language around automation. We cannot overstate how difficult this moment is for the Biden White House and, by proximity, the current Democratic candidate, the Vice President, Kamala Harris. This is really going to test them. They want to be seen that they are the sign of the unions. At the same time, they don't want chaos at the ports, and they definitely don't want reacceleration of inflation.
This has the very real potential to be a political nightmare over the next 4 weeks.
On every level, you're talking about the question of being union-friendly while also being technologically forward, by also dealing with an economy that potentially could be vulnerable. Think about how the Federal Reserve deals with data that might be muddied by as much as 70,000 jobs. You might see 70,000 jobs subtracted from the total because of some of the strikes that we're seeing. So if you're Jay Powell, do you cut? I mean, not to bring this down to 25 or 50, and that's the ultimate question, but ultimately, how do you work with data that gets messier and messier?
We do have the U.S. Chamber of Commerce coming out. You're saying this is very difficult for the administration right now, writing a letter basically to them saying it's unconscionable to allow a contract dispute to inflict such this pain on the economy. Then you go to what the Teamsters is saying this morning. I'm not going to quote him on air, Sean O'Brien, because he uses an explicit word. But he basically says the U.S. government should stay the explicit out of this fight and allow the union workers to withhold their labor for the wages.
Too early for the F-bomb. Plenty of coverage of this story throughout this morning. Look out for that. Equity futures on the S&P 500 negative here by 0.1%. In the bond market, we're shaping up as follows. A 10-year Treasury in America yields are lower by about 3 or 4 basis points. The 10-year 3.7448. Monthly gains in the equity market, monthly gains in the bond market, yields lower.
Jim Reed of Deutsche Bank put out this statistic, and I thought it was pretty incredible, that the S&P has now posted its strongest year-to-date advance of the 21st century so far in the third quarter, through the third quarter, having advanced more than 20% so far this year. We haven't seen the downdrafts, and it has been a grind through all the pessimism, the wall of worry, people who cared about the auctions, people who cared about the deficit. They were pushed aside. Instead, the bulls reigned supreme up until now.
I liked how you didn't go people who cared about the auctions. It was people who cared about the auctions. Coming up this hour, Peter Tchir of Academy Securities with Powell saying the Fed will take its time cutting interest rates. Republican Senator Bill Hagerty on the aftermath of Hurricane Helene. And we'll speak to Andrew Hollenhorst of Citi on the economic impact of port strikes on the East Coast. We begin this hour with stocks kicking off Q4 on pause as Fed Chair Jay Powell signals he's in no hurry to cut interest rates. Peter Tchir of Academy writing, there is this lingering concern for me that the post-FOMC surge was strange and it isn't getting any material follow-through. The discussion is clearly headed towards the neutral rate. The good thing about that is we all know it's a number somewhere between 0 and 5%. A very sarcastic Peter Tchir joins us now for more. Pete, we'll get to the neutral rate debate in just a moment. I want to start with that word strange. What was strange about the post-FOMC surge in this equity market?
You know, after the FOMC on that Wednesday, market sold off a little bit. They gave up some earlier gains. The entire surge occurred overnight, right? We opened up high. We actually finished slightly lower that Thursday, Friday. Last week, we keep bouncing around and talking to a lot of technical experts. Briefly, it looks like we're going to break to higher highs by significant amounts. Then all of a sudden, intraday, it turns. Even yesterday, right? We were doing okay. Powell then came out and basically said, we're going to be slow to cut. Market sold off. We rallied strongly in the end. And right now, markets don't seem to know what to do with all the news going on.
Pete, we're going to be slow because he thinks this economy is better than he thought it was. That was the message I got from that interview just yesterday. On top of that, we've got some easing out of China. And Pete, there's a lot of bulls getting very excited, very bullish. Are you saying they shouldn't be?
So I think there's two separate stories here. One is, in terms of our own economy, I actually think it's going to be fine. I would not be surprised to see that this week we actually get upward revisions to to non-farm payrolls, which has been, the bane of kind of everyone's existence, and a decent number. I don't know how the market will react to that, but I think we have to price out the Fed a little bit. So I think that provides from the U.S. weakness. I think ultimately the Chinese stimulus is going to help the Chinese companies, maybe the Chinese economy. It's not going to translate very well to U.S. companies. So I think the selling pressure on U.S. versus buying in China, which has been ongoing off and on for the last 3 or 4 days, will actually continue and accelerate after that kind of brief parabolic move.
All right, there's a lot to unpack here. I just want to go to this idea that you're saying with an upward revision to non-farm payrolls. What do you think the market response will be to ultimately what should be treated as good news?
So since I spent most of the last year arguing that payrolls were overstated, I was not alone in that. We kept pointing out issues with the birth-death model, all sorts of things. Seasonalities to me have been a big issue, that we add too many jobs in January, February. We take too many jobs away in the summer due to misplaced seasonals, both on demographic shifts and including COVID. So now all of a sudden, everyone's talking about downward revisions, how weak payroll has been. Even Powell mentioned it during his press conference about they potentially are overstated. So to me, it would be a big shock to the market if we get a decent number and actually upward revisions. Break that trend. I think the market sells off very hard on bonds. I think we go to 4% very quickly on 10s if we get something like that on Friday.
And the read through to stocks?
Yeah, I think stocks have been benefiting from this whole view that rates are going lower, that they're cutting, that the neutral rate's somewhere below 3%, and we're going to get there in July. I think that would derail it. Again, I'm talking about a number maybe 130 to 160 on jobs, so not great, not like, ooh, this is so good that stocks have to rally. Something that's like, ooh, this takes the Fed off the table, and that's what we relied on for the last 2 weeks is the Fed. So that's why we see a pullback in stocks.
We have been inundated by bigger geopolitical stories and domestic stories that should move markets that absolutely don't. And we have been befuddled all year about a number of stories like that. Now we have the biggest dock worker strike since 1977 that could potentially affect half of U.S. trade. We're dealing with the aftermath of one of the most catastrophic in terms of damaged storms in the United States. Will any of these incidents affect your view of what's going on, or are we going to ignore it like everything else?
You can, I think, add that Israel started their ground attack against Hezbollah yesterday. So you have all these major factors. So far, markets are not responding. I think on the U.S., we've dealt with hurricanes before. It's awful. We will get through it. It's super painful for the people there. FEMA and them will get their act together. We saw brief disruptions when Houston had hurricanes a few years ago. I think the market has learned, okay, this is awful for the people involved, but it tends not to have a protracted effect on the economy, so we're not going to move too much on that. The dock workers, I think everyone's waiting to see, does the government respond? Do they take some action to force the strike to end? Where does this all play out? So again, I think that will take time to grow. And then what's going on in the Middle East, I continue to believe that what we are seeing is Israel escalating to de-escalate, and that's why we're not seeing a big response from that, because Iran has shown itself to be fairly weak. The proxies have to be getting scared. So this escalation by Israel is likely still pushing towards de-escalation, where we realize that the proxies are probably going to run scared and calm things down over time.
Peter, you put out a new note about Israel, and I know you have a number of generals around you at Academy Securities. Are they concerned, though, that we are closer at this point to a wider escalation in the region, bringing in more proxy groups, given the fact that in the past few days we've had Israel now not just fighting Gaza with Hamas in Gaza and Lebanon in the north with Hezbollah, but also striking the Houthis?
We see that as a risk. But I think from a pure military standpoint, they want to take advantage of the hesitancy that's going to be in the proxy groups, right? They had the pager attack followed by the walkie-talkie attack. Then they went after groups in personal meetings, right? So really it's Bullah's in disarray. But the belief would be that every proxy is wondering what has been tapped into, how secure are they, are their lives safe? So I think there's a window of opportunity for them to press hard against the proxies. And so far, Iran has kind of been impotent, right? There have been plenty of excuses for Iran to reattack. I'm sticking with a group of generals. Not all of them say this, but a core group do say that Iran really did try and damage Israel with that 1,000 missile, drone, rocket attack. It failed. They cannot, have a second such failed attack. So I think our generals as a whole view that this is the right steps from a pure military standpoint from Israel to take advantage of this, dislocation. They will push it. This is unfortunately, again, not going to be quick. It's not going to take days. They're going to have to go through houses searching for weapons. So I think this is going to be in the headline for the next couple of weeks. But it is, from a military standpoint, the right thing to take advantage of this and keep the proxies on their heel. I think a couple of generals, even in our note, mentioned that deterrence is at best an awkward thing. It's very hard to manage deterrence without actually willing to use that force. And I think that's where we're at right now with Israel.
The U.S. will be sending more troops to the Middle East. Do your generals think that the U.S. have set a level of deterrence?
I think it's very supportive to the region. It is going to give yet further pause for Iran to attack, right? Without the carrier groups, maybe Iran would get more, aggressive in their response. With those carrier groups, I think Iran is very, very reluctant and quite frankly scared to involve the U.S. directly. So that helps tamp Iran down, allowing Israel to deal with the proxies.
Pete, I just want to throw in China just before we go, then I've got to get some breaking news on Boeing. How to play this China story, Pete? What's the best way of playing it? Because a lot of people have been piling in the last week.
So I think we went out yesterday saying we recommend taking a little bit of profits because it's been a huge gain. China's been a semi-core position for us off and on this year. We try and time it. I do think you want to start buying back. I think you get FXI, which I think is around 32 right now, which is a decent proxy for China. That gets up to 40. K-Web, which is more their internet and the names that people recognize, that did better, faster. This is going to be a slow thing. And I think just like the whatever it takes moments, we had this huge short covering surge. Everyone's like, oh, phew, now it's over. We can get back to hating on Chinese stocks. I think it's going to sink in over the coming weeks and months that this is good for China and Chinese stocks. You're going to see their consumers spend on domestic brands. That's going to grow. And to me, unfortunately, this just gives China buying time or buys time to do their made by China strategy, which is to push their brands more aggressively globally. So I'm keeping an eye on that. But I think the beneficiaries are the Chinese stock market. Yesterday's sell-off was kind of normal after a parabolic move, but I think we're going to see a steady grind higher from here.
It's something you've said repeatedly for most of the last year. Pete, thank you, sir. Peter Tchir of Academy. Here's that news on Boeing. That stock in the pre-market down by more than 3%. The reporting from the team here at Bloomberg that Boeing is said to be considering raising at least $10 billion by selling new stock, in line with the capital raise floated by Sheila Kahyaoglu of Jefferies a number of weeks ago. That $10 billion number.
Well, they're hemorrhaging cash, right? They're losing something like they've got a negative cash flow of more than $3 billion a quarter. The company is said to be working with advisors to explore its options, something a company never wants to have to say. They also are discussing raising this equity, maybe not right now, but down the road, because they want to understand what the financial implications are from the fact that 33,000 of its workers are still on strike. It's just a company with a lot of question marks around it, a lot of hair, and they need money, and that's becoming apparent.
The latest reporting from the team here at Bloomberg, Boeing is down by about 3%. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. Hurricane Helene has now killed more than 100 people across 6 states in the U.S. South. Most of the victims died due to flooding. According to AccuWeather, the economic loss from the storm could be between $145 to $160 billion, making it one of the most destructive storms on record. President Joe Biden says he'll tour North Carolina by air tomorrow morning. Meanwhile, the Wall Street Journal is reporting that PepsiCo is in advanced talks to buy Siete Foods for over $1 billion. Siete, which is privately owned, is known for its Mexican-inspired products, including grain-free tortilla chips. The report says a deal could be announced soon, at a time when Siete is set to be drawing takeover interest from private equity firms as well. And President Jimmy Carter is celebrating his 100th birthday today, making him the first American president to live a full century. Carter served one presidential term from 1977 to 1981 and then worked for more than 4 decades, leading the Carter Center, which he co-founded with his wife, Rosalind. Carter has been living in the last 19 months in hospice care in his hometown of Plains, Georgia. And last month, his grandson said the former president said he was trying to make it to vote for Kamala Harris. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the program, dock workers go on strike.
Just today had another convening that my colleagues at DOT brought together with about 60 different players across logistics and supply chains. But certainly the best thing that could happen is for the parties to quickly come to terms.
We'll talk about why that's not happening anytime soon. That conversation up next from New York City this morning. Good morning. Equities right now on the S&P 500, negative by 0.06%. I can't believe I'm saying this already this morning. Q4. Where did Q4 come from in 2024?
I mean, the funny thing about it is we've been through about 25 narratives between now and Q4. We've been through about 25 different election cycles. We've been through about 27 different geopolitical threats. And now here we are. We're staring down the barrel of the most volatile month, just sort of shell-shocked, waiting for what can possibly happen next.
We've had a hard landing. We've had a soft landing. We've had a no landing. I'm not sure what we're back to, but we've had 5 months of gains on both the equity market and the bond market. Under surveillance this morning, dock workers go on strike.
Just today had another convening that my colleagues at DOT brought together with about 60 different players across logistics and supply chains to make sure that we're mapping everything and anything that needs to happen in terms of adjustments or flexibilities across road, rail, and different ports across the United States. But certainly the best thing that could happen is for the parties to quickly come to terms.
So here's the latest. Every major port on the US East and Gulf Coast screeching to a halt as dock workers there go on strike for the first time since 1977. Union leader Harold Dackert saying we are prepared to fight as long as necessary to stay out on strike for whatever period of time it takes. The walkout threatening to ripple through the economy and reshape the final weeks of the presidential election. With us here in New York City, Bloomberg's David Gura. David, let's start here. How wide is the spread between the dock workers, the union leaders, and the companies?
It's been wide for some time, many months now, and so there was this overture last night. The group representing the docks themselves, ports themselves, saying that they've reached out, offering more money to the workers, but very late in the game. Obviously, made no impact before midnight when this all came underway. So it seems pretty wide still, although maybe there's more momentum here to talk as this picks up speed, but. A difficult circumstance, and one I think as the days go on, we're going to see sort of the economic impact, and that's going to be pretty devastating.
We saw from the employer coming out and talking about this 50% or close to 50% wage increase. The one thing that they seem not willing to change is the language on automation. How much is that becoming really the cudgel?
A huge issue, and you go back and see what former President Trump has said about this. He seems sympathetic to the argument that they were making about this, the workers were making about this before. It's definitely a huge cudgel here and something that's going to be a big issue going forward. Yes, the money matters, but I think it's also this recognition of the fact that the industry itself is changing. How do you forestall those changes if they're going to lead to layoffs or contraction in the labor force going forward? So it is that language, I think, is going to be key here as they go back to the negotiating table.
So the politics are really interesting because this is one union that hasn't made a decision on who they're going to endorse. Although in 2020, they did go for Biden.
Yes, and a smaller union, obviously, than the Teamsters, and the head of the Teamsters, Shah, brought out with a salty statement this morning saying that the government should, I'll just say, stay out of these conversations. I'll leave the expletive out of it. But, I think that that's the debate that's going to unfold here, too, is what role, if any, does the administration play? And Joe Biden saying that he's going to stay out by principle. But I think it's going to be more difficult for them to do that as this goes on. And we've seen kind of the back channel conversations that have been happening among administration officials and the union and the docs themselves.
So where do those conversations stand today?
I think over the weekend we saw the Commerce Department and economic advisors reaching out to the ports to have those conversations. Right now, I think there's probably a greater urgency to having them, probably trying to get both of these sides to come back to the table. But now I think everyone's still, at this point, just kind of looking at what's happening here, kind of trying to figure out how long this is likely to last.
How much do you have a sense that this timing isn't a coincidence? that this timing is actually very much in tandem with the election cycle to try to put pressure on this administration to grease the wheels for a better deal for the union?
Look, I don't want to be conspiratorial, but it ain't good. The timing isn't good, like 5 weeks out till the election. I think that it's added pressure for them to come to the table and come to kind of an agreement now. Obviously, it's in neither candidate's advantage or the greater economy and population's advantage for this to be happening now as we push ahead to the holidays, as people are going to buy gifts, food, all kinds of items for the holidays. But yeah, I think it's I don't want to ascribe it to that, but it is certainly a pressure point.
What I'm getting at is we've been asking on this show, how much is this happening now because workers have more leverage versus sort of the last gasps of leverage before a shift both in the economic as well as the temperature in the White House? And this question of trying to get ahead of that and using that before some real shifts in technology as well as in the political sphere. I'm just wondering how much this is an effort to get the White House to intervene on the part of the union to try to get this deal through before that window has closed?
Look, I think it's a good question. Over these last many years, we've seen the power of unions get bigger and bigger. And you look at the strike, there hasn't been a strike like this in many decades among dock workers on the East Coast where there's been this kind of shutdown. So I think that there's a broad sense among labor that they have more power now. There have been a string of successes, whether it's auto workers or others. And I think that they feel like, I think workers feel like they have more influence here than they have in the last many years.
Certainly a great opportunity for them, some real leverage for the next 4 weeks or so. David, before you go, in a moment we'll catch up with Senator Hagerty of Tennessee. East Tennessee has been a disaster zone over the last few days. I know the west of your state, North Carolina, has as well. How bad are things on the ground?
So I've reached out to a few friends of mine who live out there, two of whom are doctors, and one described to me leaving her house with no power or communications, hiking to the hospital to work there. And both of them telling me that it's hard to fathom the level of devastation that there is in that state. And I think that the real issue is just being able to access these communities. And so we heard from the governor of North Carolina yesterday, from the president from FEMA as well. A lot of supplies are being brought in aerially. President Biden's going to go there Wednesday to fly over it as well. But the flooding is intense. No communication, no power in a lot of these places, and just an inability to get in and out of these communities, both in eastern Tennessee and western North Carolina. So it's I've seen the comparison drawn to Katrina. Look, it's a smaller population, but it's remote, and there's a lot of poverty there. And I think that the devastation we're just beginning to kind of come to grips with and fathom.
Shocking pictures coming out of these states over the last few days.
Yeah, more than 100 people have been declared dead, and there are a number of people missing. Expectations for $160 billion being necessary to rebuild some of the devastation. A real question of what this means for which areas are most prone to hurricanes, given the fact that it is inland, it is away from some of the coastlines, but really flooding, a storm that just sits there and keeps dropping rain, presents some new issues that people have to really think about.
And how many people are stranded? Because in North Carolina, I looked at what some of the local officials are putting out, and they're saying you can't call 911. It's inexistent. We don't have the phone lines working, so you have to actually trek to your local emergency services to try to get for help. So there's still so many questions, so many unknowns right now.
Well, one question, did they recover in time for the election? What does this look like? What does voting look like in these states over the next month or so?
Early voting has begun in some places. I think they're trying to take steps now to figure that out. But, there's a lot of kind of political innuendo being thrown around about who's being helped and whatnot. And
sure,
we'll see what is true about that in the coming days. But certainly a compounding issue.
David, thank you for your time this morning. Appreciate it. Bloomberg's David Gura there on the strikes on ports across the East Coast and across to the Gulf Coast and the disaster zones across this country. I think we can call them that, Lisa, over the last few days.
I don't think there's any other way to describe it. People have been knocked out of their homes, no reception, and there's a real kind of new fear that people hadn't felt before, especially in areas that had newly become popular like Asheville. So a real question here about what the future brings, and then, of course, the political implications heading into November.
We'll get to some of those implications in just a moment. Up next on the programme, we'll catch up with Republican Senator Bill Hagerty of Tennessee as the Southeast struggles to recover from Hurricane Helene. That conversation just around the corner. Equity futures on the S&P 500 just a little bit softer. We're essentially unchanged on the S&P at negative 0.04%. A bit of a rally in the bond market. Yields lower by close to 4 basis points. Your 10-year 374.29 from New York. This is Bloomberg. 5 months of gains on the S&P 500 kicking off October and Q4. We're negative by 0.02%. On the Nasdaq 100, we're positive by 0.1%. On the Russell, just a little bit softer. The Russell on the quarter in Q3 up by close to 9%. Stunning rally for the small caps.
That was a quarter that we just had that really was marked by the outperformance of the broadening out of the equal weight of the Russell 2000, and it came in tandem with yields heading lower for a fifth consecutive month. A real question of whether that can continue.
Well, let's get to that bond market move. 2-year, 10-year dropping for 5 consecutive months. Moves we haven't seen on the 10-year going all the way back to 2010, which I was very surprised by. Yield to lower by 4 basis points on a 10-year this morning, 374.29. The 2-year pretty anchored at the moment here, Lisa, 361.25, following those comments from Chairman Powell yesterday afternoon.
Looking forward, if the economy evolves broadly as expected, policy will move over time toward a more neutral stance, but we are not on any preset course. That's me channeling Jay Powell. That was his comment yesterday. We also heard from Goolsbee and Bostic and Bowman yesterday, and it was all over the place. Basically, Bostic coming out saying he would support a 50 basis point move should the data warrant it. Bowman continuing to be the one herald of potential inflation. So she was the resident hawk, and Goolsbee being like, we need to cut aggressively, let's just get it down. So, basically, where does this leave us? This has really changed the scenario all that much.
We wondered whether we'd get a sprinkle of Goolsbee from Chairman Powell. I think that's where the bias of the market was. Perhaps he'd come out and say we're a long way from neutral, suggested that maybe the next few moves were the easier moves, and I didn't hear that at all. In fact, I heard a chairman that was much more confident about underlying growth in America following recent data.
Which is the reason why you saw a bit of a sell-off in Treasuries, yields a bit higher on the heels of this, but suddenly people thinking, wait a second here, he's not super dove, he's something that's a little bit more balanced. And does this mean that the Larry Finks of the world of BlackRock are correct, that basically the market's gotten way ahead of itself with how many rate cuts it's priced in and needs to temper that? How much is that a risk and how much does that matter heading into non-farm payrolls for the likes of risk assets, given the fact that good news ultimately, according to Mike Wilson of Morgan Stanley, should be good news?
Payrolls just around the corner. I want to finish on foreign exchange. Euro dollar negative by 0.4%. It's a break of 111. It's 110.88. Eurozone headline CPI coming out a little bit earlier, dropping below 2% for the first time since 2021. So if we're having conversations about big rate cuts at the Federal Reserve, why are we still not having them at the ECB?
You have Germany falling below 2% in terms of inflation for the first time since 2021. The Euro region inflation rate, 1.8%. You have the prospect of a recession, an entrenched recession in the biggest economy in the region. And then you have Christine Lagarde saying, well, we'll check the data as it comes. It's sort of people now baking in a whole host of rate cuts by the ECB by the end of the year.
A weaker euro, 110.88. Under surveillance this morning, some top stories for you. Israel beginning targeted ground raids into southern Lebanon. The Israel Defense Forces saying its forces are striking targets located in villages close to the border that pose an immediate threat to Israeli communities in northern Israel.
I think really the key word there is targeted. So I spoke with a U.S. official yesterday who basically said there was this understanding between the White House and the Israelis that the scope of this would really be towards and limited to that border. A big question based off some of these calls I'm having is what will Lebanese Hezbollah do? Will there be some sort of retaliation? And then how much longer, the U.S. puts out these statements about this idea that they don't want this to expand. They want to see peace in the region. How much longer does this push diplomacy down on the timeline? I was struck by what Lloyd Austin and the Israeli defense minister put out yesterday, Gallant. They agreed on the necessity of dismantling attack infrastructure along the border. So the big question will be here whether or not it extends past that.
Yeah, just to put it another way, how much do they have to do in order to get the 70,000 people in Israel back to their homes in the north? And that ultimately still remains to be one of the big questions.
We've just seen a series of escalatory steps over the last week, and they continue. I want to turn to this story, just a quick update for you. Dock workers walking out of every major port on the US East and Gulf Coast for the first time since 1977. The strike halting container cargo and auto shipments from Houston to Miami. JP Morgan estimating the economic loss from the shutdown will be between 3.8 to 4.5 billion US dollars every single day. Andrew Hollenhorst of Citi with us in about 15 minutes. Look out for that. J.D. Vance and Tim Walz facing off in New York tonight for the only scheduled vice presidential debate. The candidates aiming to boost their campaign's momentum when they take the stage at 9 p.m. Eastern time with Election Day 5 weeks out.
So what's interesting about this is we're ending this election cycle potentially on a final debate, and it's not the top of the ticket. It's the vice presidential candidates. Their mics will be hot, so potentially there will be real moments, tangible moments where they have these back and forth. They've been sniping at each other for weeks, so this is going to come really to the forefront today. So I'm interested to see what kind of movement there is with the mics. And the whole point of a VP is to do no harm. So I think who does harm today will depend on who wins.
I'm just curious, what's the point of this? I mean, I'm serious. Is this to get policy, or is this
what's
basically...
What's the point of the debate?
Or, no, in this particular debate, is it basically policy? Is it favorability? Is it like an MMA match where people want to see who gives a strikeout? I'm serious. Is it entertainment? I actually am curious because I wonder how much this is actually to determine policy beyond what we've already heard.
All right, it's going to be a lot of style, a little policy, but I think it depends on the viewer, depending on what you want to get out of it. These two men are pretty relatively unknown, especially
Sure.
Governor Walz. I mean, maybe they're reigning kings in the Midwest, but on the coast, they're not that well known. I think this is a chance for both of them to acclimate themselves with American society.
Stay tuned for Bloomberg coverage later on this evening at 9 p.m. Eastern Time. The US Southeast grappling with the aftermath of Hurricane Helene. More than 100 people have died across 6 states, with floodwaters destroying homes, leaving millions without power and cutting people off from fresh water. Republican Senator Bill Hagerty of Tennessee joins us now for more. Senator, thank you very much, sir, for taking the time to share your thoughts with us this morning. I know that your state is going through a lot right now. I don't think the rest of the country still fully understands the magnitude of the issues on the ground. Senator, you've been surveying and assessing the damage. Could you share with us what you've seen?
Well, again, thanks for the opportunity to share this with America and with the people around the world. The devastation is enormous here. Just to put it into perspective, they talk in terms of events that occur 1 in 100 years, 1 in 200, sometimes an event like this 1 in 500 years. We've seen one of those back in 2010, very concentrated around Nashville. This is one in greater than 1,000 years. We've never seen anything like this, Chris. And it was explained to me, if you look at the volume of water that came down through this rainfall, this storm, and spread it across the state of Tennessee, it would equate to a depth of 3 feet of water across the entire state. Just let that soak in for a moment. I was talking with the director of the Newport, Tennessee Utility District yesterday. He told me as the water came in, it was ankle deep, and then he started seeing it moving. He told his men to run. In 5 minutes' time, it was chest deep. That's like a tidal wave hitting. It's going to forever change the terrain in this part of the country. I was with Mayor Woodby yesterday in Clark County. She was telling me about the Black Hawk helicopters that I just saw her get off of. She disembarked a Black Hawk helicopter to come talk with me. They're running water generators, supplies. She said she needs oxygen. They're having to use helicopters because these towns and cities are cut off. They've lost the bridge access. They've lost road access. There's no way to get there except by military helicopter. And I have to say our National Guard has stepped up tremendously. As of yesterday afternoon, there are going to be between 220, 250 guardsmen on the ground there. We've got to continue to accelerate this. We've got to get debris removal crews in here now. FEMA's got to step up, and I think they're doing everything they can, working with our local Tennessee emergency management to step up, get resources here, assess the situation immediately. The water's receded adequately now to see the massive extent of damage, but people are hurting very, very badly right now. As I said, we need oxygen for people that have to have this. We've got to get these to people who are landlocked and cannot access roads and highways to get out of the area. Helicopters is the only mean access right now.
Senator, you alluded to it. Let's build on it. Are you getting all the help you need from the federal government?
Yep, my job is to make certain that we do. And I spoke with the White House yesterday. I'm sure I will speak with them again today, just to continue to update them and make certain that we keep pressure on the situation. I think all eyes were pointed toward Florida in the beginning. That was the initial landfall, but the resources have been diverted there. Far more are needed up here in Tennessee right now. Same is true in North Carolina. I talked to my colleague Ted Budd yesterday. Western North Carolina hit extremely hard. And what happens is you've got whole communities that are isolated. They don't have water. The water management system here is in enormous trouble. Wastewater management. There are several systems that are completely out, meaning people are on boil alerts. They can't even get water through the pipes. And if you can imagine how water gets to some of these communities, they use bridges, not only to transport vehicles and people, but those bridges have pipes running underneath them that they're using for water supply. Those bridges are out. The water supply is gone. Electricity, a big issue. Tennessee Valley Authority, largest utility in America, the most sophisticated when it comes to water management and dam management systems. They've done a tremendous job getting people back online, but we still probably have 16,000, 18,000 people that don't have access to electricity. Thankfully, it's the fall. The weather is relatively mild, but this is a serious, serious challenge. And what we've got to do right now is manage the level of our lakes, manage the dam system so that we can get this water moving out of here, because there's another storm brewing in the Atlantic that, if it turns the wrong direction, could be here again in another week.
Senator, it's great to hear that you're getting all the help you need right now. Biden was asked, though, yesterday if Congress should return for a special session. He said that is something I may have to request, but no decisions have been made. Do you think Congress needs to return to make sure places like Tennessee continue to get that aid that you so desperately need?
I would be all for that. I know that we're looking at every way to accelerate funding right now, but this is a critical situation, one that we've got to address. And if additional emergency funding needs to be put through, we should get to Congress. We can do it in a day, but we need to do everything we can. We have citizens that are literally going to get worse by the day as they don't have access to water, they don't have access to electricity, and importantly, don't have access to critical medical care, as I mentioned, access to oxygen or other. You think about kidney dialysis, those sorts of things. This is going to get critical, more and more severe as we move along. The ground is also saturated. So if we do have another event, it's going to be much worse. So we really have to deal with this as rapidly as possible and resource this very, very quickly.
You talked about the power outages. A lot of the reports we're seeing is that a lot of people can't even call 911. Do you have a timeline of when potentially you're going to get power lines back up and running?
The Tennessee Valley Authority is working night and day on this. I met with many crews yesterday. I was with the TVA team a good part of the day yesterday. They're getting power up as quickly as they can. An important piece of this, though, is getting broadband back up, because our wireless system isn't working in that area. So we have a lot of people that are missing. I talked to the school principal yesterday. He's missing a number of the children in the school. That doesn't mean that they are in harm's way, but he can't communicate with them. That is creating a tremendous amount of anxiety for families here, as you can imagine. They don't know where their loved ones are. They don't know how to reach them. And it's going to make it extremely difficult to locate folks until we can get that system back up. So Tennessee Valley Authority is working night and day on this aspect, too, as are the carriers.
Have there been any discussions about Starlink? I know that was one thing that was floated.
Yes, Starlink is being implemented right now. I was with emergency responders yesterday. They were uploading Starlink, so that is being utilized right now. At this point, it's only with emergency responders. We'll continue to see how we can broaden that access, but as you note, communication is going to be very critical, and Starlink may be an important part of that.
Senator, you mentioned that the land was saturated, and if we get another event, you could see just a real escalation of a lot of the trauma that's been experienced. How do you develop the land and sort of recover from this and give people the confidence that there are new safeguards in place to really protect should there be another massive storm that comes through?
Well, as I said, this storm was so unique. The magnitude of it's something that we haven't seen in recorded history. If it's a greater than 1 in 1,000 year event. At the same time, though, this has put us in a much more vulnerable situation for the next big storm that comes along. So the saturation of the ground, the fact that we already have water treatment facilities that are out, it's going to require incredible management just over the next week to make certain that we're in the best possible condition to take another hit like this. I'll just share with you a snippet, a story of what's happened here just over the past couple of days. An important bridge, a critical bridge to get to a community was tested. The bridge was okay, but a 2,000-yard segment at the approach had been washed out. The local county managers are out trying to assess what to do. And a gentleman came up and he said, I've got a bulldozer. Maybe I can help. They said the next thing they knew, he brought several more pieces of equipment. He brought more friends. And in about 36 hours, they worked through the night. They had rebuilt this 2,000-yard section. That bridge is open now. That's a Tennessee volunteer for you. We are seeing outpour of help and volunteerism like we've never seen before. But we actually need resources and equipment, as I mentioned, debris removal equipment, things that the National Guard can provide that require certain expertise, getting electricity back up, getting water management up. It's going to take some time. It's going to take resources. And thank you for giving me the chance to explain this to the people of America.
No, thank you for your time, sir. I think that's a good place to finish this conversation. If people outside of the state want to help, what's the best way they can contribute to your efforts?
The Red Cross and the Salvation Army are on site right now. They have networks in place that are very good at working with this. The Tennessee Emergency Management Association on the ground here knows exactly where the critical points are. That's for people that want to actually come volunteer, help, and work. And we've got a tremendous amount of damage to work through. This is going to take not days, not weeks. It's going to take months to navigate through this, in some cases with massive infrastructure that's been damaged, even longer than that. But I'll say this, our dam system has held up remarkably well. The Tennessee River is an incredible water system. We've put it in place over decades, and it has proven to be extraordinary. I was at the operations center yesterday that the Tennessee Valley Authority uses to manage all the various water levels that they've got to do to get water moving from a higher lake to a lower lake to the next lower lake. And it's incredible what they've been able to do and accomplish. The damage would have been far worse had we not had this technology in place.
Well, you and the people of Tennessee are in our thoughts. Thanks for being with us this morning, sir. We appreciate it. Thank you. Senator Bill Hagerty there of Tennessee. A difficult moment for that state and many states across this country right now.
And we're just beginning to understand the depth of how much damage has been done and how long it's going to take to really recover.
Let's get you an update on stories elsewhere this morning. With your Bloomberg Brief, here's Yahara Heckers. Hey, Yahara.
Hi, John. Bloomberg is reporting that Boeing is considering raising at least $10 billion by selling new stock. According to people familiar, the plane maker is looking to replenish cash reserves that have been further depleted due to the ongoing strike. Boeing has burned through cash following a near catastrophic accident back in January that forced it to slow production of its 737 MAX airliner. Meanwhile, Michael Dell has unloaded more Dell stock. He sold 10 million shares of his namesake company stock worth more than $1.2 billion. This marks his second significant sale in September. Earlier, he sold 10 million shares worth more than $1.1 billion. The stock is up nearly 55% year to date as Dell benefits from investor interest in artificial intelligence companies. And baseball legend Pete Rose died at the age of 83 on Monday, according to his Cincinnati Reds spokesman. Rose had a storied career, winning 3 World Series championships, 3 batting titles, and making 17 All-Star appearances. Though Rose maintained for years that he never bet on baseball, he admitted in a 2004 autobiography that he did in fact wager on the Reds while managing the team. He continued to insist that he only bet on the Reds to win and never manipulated the outcome of any game. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. Up next on the programme, ports across the country grinding to a halt.
Anything that's a negative supply shock in our language that's going to raise the cost of doing business or lead to shortages, the impacts are never good.
A conversation just around the corner. The latest from Citi up next. Max Kettner, HSBC. The most frequent question we currently get, what does it take to make you bearish? Upside risks are barely discussed, and that's why he's bullish. More on that note a little bit later. Equity futures on the S&P 500 totally unchanged, and the bond market yields a little bit lower. We're down 4 basis points on a 10-year. Let's call it 374. Under surveillance this morning, ports across the country grinding to a halt.
We've gone through in the last year or two a big strike in the auto industry. We've gone through the port collision with the bridge that affected shipping. Anything that's a negative supply shock in our language that's going to raise the cost of doing business or lead to shortages is something we're just going to have to deal with, and the impacts are never good.
Here's the latest this morning. Dock workers launching a strike across U.S. ports from Maine to Texas for the first time in nearly 50 years. Andrew Hollenhorst of Citi warning if the strike extends beyond a few days, shortages of certain production inputs could eventually slow production and raise prices for manufactured goods like autos. Andrew's with us around the table for a whole lot more. Andrew, in your research, and welcome to the programme, you use the word escalate. Just spend some time talking about the economics of this. The longer this goes on, the chart kind of looks like this.
Yeah,
the costs
right,
just
John.
exponentially get higher.
First few days, the economy can handle, we think. There should be stocks of inventories that are there at the dock, that are there in retailers' inventories. But then as you go on, you start to worry first about things that are perishable, right? Bananas are getting a lot of attention, appropriately so, almost entirely imported. So you go a few days, those bananas that you had unloaded start to no longer be the nice fresh bananas that you like, and you run out of bananas. Now, that's one small issue, right? You can switch to apples, right? There are other things that you can consume. The bigger issue is, do you have inputs to the production process that you really can't substitute for? Are there semiconductors that are sitting on a ship offshore? Are there important other components to the auto production process? That's what we're really concerned about. Now, that would probably take days or even weeks weeks to start to show up. So absolutely, this just escalates as it goes on.
A lot of people saying it's going to take about a month to get things back in gear once there is some sort of resolution, if it does go on for a significant period of time. How are you gaming out the economic ranges that we could see depending on how this really turns out?
It just really opens up the distribution of outcomes, because as we go further along, and I think President Goolsbee was just talking about this, we've seen strikes before, so we look at the prior strikes, we try to get an idea of how this could affect things. We had this on the West Coast some years ago, but the West Coast imports different products than the East Coast. I mean, we remember this so well from COVID, where it's really hard to game this out until you actually know what is that individual component, what's the widget that you need in that production process that you run out of, and then to your point, how long does it take you to restock that after you've had a disruption?
We've already had a lot of questions around the economic data we've gotten in terms of its accuracy. Now you throw in the Boeing strikes, you throw in dock worker strikes, you throw in the storm. How do you back out all of the potential one-time disruptions and understand what this data is telling us at all?
Yeah, I keep thinking about the July jobs report, and I don't know if people remember, but we spent a lot of time, and Fed officials spent a lot of time talking about the effects of Hurricane Beryl and whether that had an effect on that jobs report, whether that was obscuring what was going on. The events that we've had over the last couple of weeks, the strike, there are other strikes going on. We have Hurricane Helene, of course, with a human cost as well as an economic cost. That is going to be much more significant than what we saw with Beryl. So if we thought that made it difficult to interpret that July jobs report, really, this jobs report that we're going to get this week, this should be clean, but this might be the last clean one, at least for a couple months.
When it comes to the input costs that potentially this could rise when it comes to dock workers and the strike, what sectors would see that? What sectors are most inflationary?
So the first place that you'll probably see this is perishable goods, things like fruits and vegetables. Now it's not clear how much will prices rise in the very short run. Does a retailer increase the price because they're out of stock, or are they just out of stock? That's what you tend to see, is maybe not so much of an effect on the price, but this is just absorbed by retailers. To your point, it's as you start moving into that production process, it could be a few weeks from now, you can't import a car. It could be a month from now where you can't produce the new cars. And then that's where retailers will have to start to say, we actually have to raise these prices. We have a shortage of goods. We have to raise prices. But exactly like Goolsbee was saying, this is the kind of shock that you don't want to see in the economy, because it raises prices and it slows growth.
Speaking of shocks, payrolls Friday, okay? Bear with me. The estimate for Friday is 150. The high over at Jefferies is 220. And then there's this guy that put in 70 for Friday. This guy's you. What's going on over at Citi? Where does 70 come from?
Yeah, I think it's not that hard to get to a 70 number. And that's what's interesting about the forecast to me. If you look, so there's an argument for 150, which is that if you look at maybe a 6-month moving average or a longer moving average, we'd be running around 150,000 payrolls. But there's an argument for 70, which is we're running in the private sector at about 90,000 jobs per month and overall about 100,000 jobs per month. And then we have some specific areas of weakness where we've seen construction activity that's really slowed down, but we still have a lot of construction workers. Now, we kind of saw this in manufacturing last month, where we had a big decline in manufacturing payrolls. We'd already seen several months of weaker manufacturing data. So we think that the employment data is going to kind of catch up with some of what we're seeing in activity. But the point you're making, I think, is a good one, that there's a range of outcomes that are possible.
If I'm an investor, should I be scared of 70? Should that worry me about the trajectory of this economy?
I think it should. I think you should already be worried by 90,000 a month private payrolls. This is really a level of job creation that we usually see only going into a downturn, or at least a significant slowdown. And I thought it was really interesting, Chair Powell, yesterday, he was asked this question: the rise in the unemployment rate, is it a supply story? And he said, at this point, we really have to look more at the demand weakness side of it and the slowing in payroll growth.
That's your camp, and has been for a while. Andrew Hollenhorst of Citi on the latest with the port strikes, what it might mean for the economy, and looking ahead to payrolls Friday. The estimate there is 150 on Friday. Andrew's looking for 70.
And meanwhile, the data is going to get only messier from here in terms of trying to interpret it. Just a public service announcement. There are more than 1,000 varieties of banana, but we only eat one of them, and it is potentially fragile, and it will potentially not be there for your breakfast.
You can have apples instead.
Yeah, but that also is threatened by the strike.
That's threatened too?
Yeah, so just be careful.
OK, no fruit.
No fruit for you.
No fruit for you. No fruit for you. Coming up on the program, Seema Shah of Principal Asset Management, Republican Congresswoman Lisa McClain of Michigan, Bloomberg's Danny Berger as the port strikes ramp up, and Lindsay Rosner of Goldman Sachs Asset Management. The second hour of Bloomberg Surveillance up next.
We're in the midst of a global easing cycle, but a fast-moving Fed can open the door for that to be faster.
We do have a great soft landing scenario right now.
If you were to get a reacceleration in inflation, I think the Fed goes on hold.
Our base case is one more 50 and then back to 25s, but honestly, everything's on the table for this Fed.
The impact of the eases won't be known until the middle of next year.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The second hour of Bloomberg Surveillance starts right now. 5 months of gains in the equity market, 5 months of gains in the bond market, kicking off October and Q4 looking like this. Equity futures on the S&P 500 just about positive by 0.05%. On the Nasdaq, we're positive about 1/3 on the Russell, just a little bit softer. The scores for Q3, the S&P up around 5%, the Nasdaq up around 2%, the Russell up around 9%.
This has been really the story of Q3, this idea of rotation gaining traction, yields lower, fueling this feeling that maybe we are on the cusp of a new cycle that could really lift up some of the other 493 and beyond stocks. Question now is, has this market gone too far, too fast with respect to rate cuts and just how much that can save everything?
We are data dependent, so let's talk about the data. The week ahead looks like this. Later on this morning, 10 a.m. Eastern time, you'll get ISM manufacturing and job openings as well. Look out for that. And as we work our way through the week, at least we're working towards payrolls on Friday. The estimate in our survey, about 150.
And basically, the key question here is how high or how low is the threshold for this Federal Reserve to come in with another massive rate cut? I would argue on the flip side, whether it's Mike Wilson or Peter Tchir, a real question about how hinged this market is to either an upside or downside surprise. Peter Tchir earlier this morning saying an upside surprise would actually cause just as big, if not a bigger sell-off as people recalibrate just how many rate cuts really can happen.
Reading this economic data is always nuanced, complex, difficult. It could be even messier. Lisa mentioned this in the last hour. We're talking about the first major strikes on US East and Gulf Coast ports since 1977. And the longer that goes on, the messier this data gets.
And it's half of U.S. trade. This could be potentially, and if this lingers on, a tremendous amount of chaos at these ports. And to Andrew Hollenhorst's point is in the beginning, it's not the impact that you'll feel almost immediately, but then that can build up, whether it's bananas or semiconductors that go into autos. Potentially this can have an inflationary impact on the economy and the jobs. Not just this, but also the crisis that's going on in the southeastern states when it comes to the hurricane. How messy is the next payroll report going to be?
Well, Andrew Hollenhorst was talking about Hurricane Beryl and how that caused some question marks around some of the jobs reports in the summer. That was not quite as significant as any of the things that we're seeing right now, even in taken in individual. Meanwhile, we're talking about the potential. Morgan Stanley's Seth Carpenter coming out saying maybe 70,000 jobs have to be taken off the total as a result of some of what we're seeing right now. The data has been difficult to interpret. It has been difficult to understand this cycle. Just imagine how much more difficult it's going to get to really understand.
Yeah, the October jobs report could be an absolute mess. And you'll get that report just before you get the November 7th Federal Reserve meeting, which is 2 days after an election we might not know the outcome to.
That's perfectly framed. Just how much of a black box is this Fed operating in? And then, in turn, is this market operating to understand the Fed's reaction function and then to even understand the trajectory of the economy? And this is the reason why the bifurcation of the upside and the downside for this economy has just continued to grow despite the ongoing string of data that we're supposed to be dependent on.
We've said it repeatedly on this program, flying blind into 2025. Equity futures on the S&P 500 firmer here by almost 0.1% after the run we've seen in the bond market. 5 months of gains for treasuries. That means yields declining for 5 consecutive months. Yields are down again, kicking off October. We're down by 4 basis points to 3.74. Coming up this hour, we'll catch up with Seema Shah of Principal Asset Management as we kick off Q4. Republican Congresswoman Lisa McClain on the swing state politics of Michigan. And Bloomberg's Danny Berger as thousands of port workers walk off the job. We begin this hour with US stocks posting 4 consecutive quarters of gains, the longest streak since 2021. Seema Shah of Principal Asset Management writing this: the attractiveness of cash has declined. There is some $6.4 trillion currently in money market funds, potentially representing an important tailwind for risk assets. Seema joins us now for more. Seema, you sound bullish. Walk me through why and where that cash is going to go.
Sure. So yes, we are bullish. I don't want to say overly bullish. We're very cognizant of the number of risks out there, but I think what we're really basing it on is you have a global monetary stimulus cycle in play. You have a Federal Reserve, which, yes, very, very clouded, very difficult to navigate its way with all the uncertainties that you've been talking about with regards to the data. But they are very much committed to soft landing. So that's the one thing that we are hanging our hat on, is you're very unlikely to see a recession materializing over the next 18 months. So that is a good backdrop. It doesn't necessarily mean that you're going to see enormous equity gains. I actually doubt that you're going to see the same kind of pace of gains that we've already seen in the first 3 quarters of the year extending through to 2025. But you have a growth backdrop. You have a Fed monetary easing program in play. That should be positive for stocks. It should be positive for credit as well. So from our perspective, why be in cash when you know that rates are coming down and there's so many other gains to be had on risk assets?
The story you describe is precisely why we've had this massive US overweight, and it's been building over the last few years relative to the rest of the world, because the relative story around the world has not been great. Seema, with that in mind, is it time to rejig some of that story, cut some of that overweight, redeploy some capital abroad, look internationally? And a question I think a lot of people are asking themselves this morning is, well, I've seen this movie a few times. This has been head fake after head fake. I know how this ends. Is it different this time?
So I don't want to use those words. I'll get told off by all my colleagues for saying that. But I do think that this is a time to be thinking about global diversification. It's not necessarily pulling away from the US. So, with all that cash sitting there, you need to deploy it somewhere. It's about whatever you're going to add, try and think about where the global diversification is, because valuations around the world, in some pockets, not everywhere, but they are quite attractive. And as I said, it's not just the Fed that is easing, but you're seeing other central banks around the world moving. I think China is an interesting story. We have a lot of, I think, skepticism about how much it's going to be sustained, how significant stimulus is going to be, how it's going to be implemented. But we do think that there will be positive benefits from a risk sentiment perspective for other parts of Asia. So I think that there are places outside of the US that we can think about, but also within the US. We've all become very accustomed to having that exposure to the Mag 7. We're maintaining that. But I think there is also some space for some tactical opportunities within the small cap space.
I want to understand the bullish case and what's been priced in already, especially when it comes to the relationship of stocks and bonds, stocks and the Federal Reserve. How much of the rally and your bullish sentiment really hinges on this rate cutting cycle that will pick up steam even if we don't necessarily get really negative employment data?
So I think some of it is hinged on it. But as I said, we're not expecting the gains to continue at the same kind of pace we've had. I actually think that it's quite difficult in this market with these kind of valuations, unless you were to have some kind of clean out at this point, to have another 20-25% move higher. So we're thinking more about in the single digits for returns. There is a lot of uncertainty about how much the Fed is going to cut within the next few months. Are they going to front load, or are we going to be looking at a more of extended cycle? But as I said before, the thing that we're thinking about is, look, the Fed we know is committed to that soft landing. They've started to cut rates against a backdrop of still positive growth where there is no financial crisis simmering. That is a very, very positive backdrop, which should assure a soft landing. And against that perspective, then you should have continued earnings growth and equities moving higher. But we do think that instead of just focusing on the Mag 7, it's really time to think about other parts of the US market and the global complex.
I feel a bit whipsawed, Seema, because we've been talking about all of these catastrophic situations around the world and how it could potentially affect employment, how it could affect inflation, how it could affect growth over the short and potentially longer terms, how it could disrupt supply chains. And yet markets have shrugged it off, don't seem to be pricing it in at all, which I guess makes sense because in the past it hasn't come to fruition as a tangible risk. Of the potential issues that we see on the fore, whether it's the storm, whether it's the strike, we're talking about the U.S., whether it's what's going on in the Middle East, what do you have your eye on potentially as the most disruptive event?
I actually think that the disruptive event is of course, this is from a market perspective, the most disruptive event is really what it does to the data. We know that this is a Fed which is very data dependent. This is a market which is also very data dependent. So as much as the data becomes more and more muddied, I think that you're going to see a lot of whips, and we've already seen volatility pick up. That there's a risk that continues or even exacerbates over the coming months. And of course, there's always a chance that you take the wrong turn because you're so clouded and blinded.
When it comes to China, I know you mentioned that earlier, but you talked about that this week was a pivotal moment for it. It all comes down to the details. So far, do you like the details that are coming out of Beijing?
Yeah, we do. We are quite encouraged by what we're hearing. We really need to see clear numbers. We need to see a little more information about the consumption drive. Are we seeing kind of direct injections to consumers, or is it done through subsidies? So there are different ways which are going to make it a little bit more impactful or less so. But overall, I think the positive thing that we're hearing from the government is that they recognize that something needs to be done, and it needs to be done in conjunction with monetary stimulus. It's not enough just for monetary policy cuts. There has to be some kind of spending coming in play. I think that is positive. It should have a good impact on risk sentiment in terms of how much further we think about China GDP growth going. Does it hit the 5% level or not? That really comes down to those specific details. But at least for this point in time, we're hearing all the right things from the government, and that should have some positive externalities across outside from China as well.
Can we talk about the limits of that positive fallout? Let's talk about that right now. Tchir of Economy was on the programme about an hour ago, and he made the point that the story out of China is a story for China. Chinese brands, Chinese companies. And the spillover, the positive spillover, is limited to the rest of the world, particularly to European companies. Seema, what do you make of that argument?
I wouldn't necessarily agree. You know, when we've done the charting, there's actually a pretty clear correlation. You have China credit stimulus or whatever kind of stimulus measure that you want to use. There is a clear impact on the US ISM manufacturing survey, for example. So we do think that there is a positive impact. And in fact, for European companies, you could actually see some of the luxury companies benefiting. So China's consumption has been limited within China up to now. We could see that streaming out to other parts, particularly in Europe. Now, I don't exaggerate this because we're actually quite negative on Europe as a whole. But in terms of what the impact could be outside of China, I don't think it's huge, but I think it certainly could be quite positive, particularly at a time for the rest of the world when expectations have been quite low outside of the US.
Rock bottom over the last few years. Seema, thank you. As always, Seema Shah there of Principal Asset Management. Equities just inflecting just a little bit higher, turning positive. We're up by 0.1% on the S&P 500. With an update on stories elsewhere this morning with your Bloomberg Brief, here's Yahara Heckes. Hey, Yahara.
Hi, John. BlackRock CEO Larry Fink thinks the market is pricing in too many Fed rate cuts. In an interview with Bloomberg's Francine Lacqua, Fink said it's tough for him to see another 50 basis point cut given growth in the U.S. economy.
I see more policies by more government that tend to be more inflationary than deflationary. And so with that in mind, it's hard for me to see another 200 basis points of decline in short rates.
Fink went on to say he believes there's more room for easing, but not as much as the forward curve would indicate. Meanwhile, Abu Dhabi National Oil Company has agreed to buy German chemical company Covestro for about 12 billion euros, and what's lining up to be the biggest Middle Eastern acquisition of a European firm. It also marks ADNOC's biggest acquisition to date and helps diversify the state-owned company's operations at a time when oil demand has slowed. And nearly 200,000 Jeep SUVs are being recalled globally due to the risk that they could catch fire. Stellantis said the recall affects recent models of its Wrangler and Grand Cherokee plug-in hybrids. The company said drivers should avoid recharging the vehicles until a fix is ready. It's the latest blow to Stellantis amid a slide in sales and unrest among dealers who say they can't get Stellantis cars off their lots. That's your Bloomberg Brief. John?
The hits keep coming. Yahara, thank you. More from Yahara in about 30 minutes. Up next on the program, it's Vance versus Waltz.
Speak to our fellow Americans like they're citizens, because they are. Kamala Harris speaks to her fellow Americans like they're children.
It's what people don't say, and it's what Donald Trump never says. He didn't say anything about how he was going to make life better for the American public.
That conversation up next, live from New York this morning. Good morning. Kicking off Q4, which I'll keep saying for my own benefit because I can't quite believe it. Q4, last 3 months of 2024.
Just a guessing game. How many more narratives do you think there'll be in Q4?
5 in October.
5 in October.
That's my guess.
My guess is 17 through the rest
The
of the
story
year.
around this economy is going back and forth, back and forth. Bank of America this morning, risk is to the upside, absent a big miss in Friday's payrolls report. Equity futures this morning just about positive by 0.05%. Under surveillance this morning, it's Vance versus Waltz.
We speak to our fellow Americans like they're citizens, because they are. Kamala Harris speaks to her fellow Americans like they're children. And so what I'm just going to try to talk about here is explicitly what we're going to do to make your life better.
It's what people don't say, and it's what Donald Trump never says. He didn't say anything about how he was going to make life better for the American public. He didn't say anything about how it was going to impact your family. You win an election to improve people's lives.
Here's the latest. J.D. Vance and Tim Walz facing off in the only vice presidential debate of the election. Beginning at 9 p.m. Eastern Time without a studio audience, the candidates will have 2 minutes to answer questions and 2 minutes to react. Both Walz and Vance will have hot mics. Republican Congresswoman Lisa McClain from the swing state of Michigan joins us now for more. Congresswoman, it's good to see you.
It's good to be here. Thanks.
Welcome to New York.
Yeah, thank you.
Welcome. What are you hoping to get from this evening?
Well, I hope to get a contrast, right? And what I think I'm really hoping for is what exactly the American people are hoping for, and that's answers to the questions of the issues that everybody's worried about. The economic issues. What are we doing about the hurricane? What are we doing to bring inflation down? What are we doing about the EV mandates? What are we doing about crime? They want answers to the issues. And I can share with you in Michigan, there are 3 issues that matter. Economy, economy, and economy. That's the bottom line.
Where's your economy right now in the state of Michigan, and what can the federal government do to help these automakers?
Our economy in Michigan, we're struggling. Families are struggling. We're struggling to put food on the table, put our gas in our cars and whatnot. What the government can do is stay out of the way. I mean, seriously. Just have some faith in the people. We don't need more regulation. We don't need the government to tell us what to do, when to do it, how to do it, what cars to buy. Have a little faith in the American people.
You've been very critical of this administration when it comes to the transition to electric vehicles. Yeah. At the same time, you're also very critical of China.
Yep.
But China is absolutely dominating the entire world when it comes to electric vehicles, as well as the processing to make the batteries to get to that electric vehicle. So how do you suggest the U.S. compete, given this is so critical to your district?
The biggest thing that we can do to compete is stop the mandates. Let the consumer buy the product they want to buy. Listen, with the 70% EV mandates by 2030, we don't have the infrastructure. I mean, I'm not telling you guys anything you don't already know. We don't have the infrastructure, and people don't want to buy the cars. Not to mention, where are we getting all the batteries from? Oh, our biggest adversary, China. And for those of us who really care about the Green New Deal, right? Okay. That was a little bit of sarcasm there. But for those of us who care, where are we getting the batteries from? China. What does it take to produce those batteries? Coal and coal plants. It's counterproductive and counterintuitive on what we're doing with these EV mandates.
When you say mandate, there's not an explicit mandate. It's just the pollution controls. So just the question I have is, the Inflation Reduction Act, which I know you're critical of, you called it the Green New Deal, so you clearly are critical of it, but a lot of that money actually went to Michigan for clean tech. So say there is a change in the composition of Congress or change in the White House. Are you going to be one of those individuals that wants to repeal some of those provisions that are in the Inflation Reduction Act?
Yes, and I say that because I have faith in people. And in the Inflation Reduction Act, with these mandates, right, I think everyone wants a cleaner planet, right? But who's going to give us that cleaner planet? I'm going to share with you, it's going to be business and it's going to be industry, the people that do it for a living every day. The government's not going to be able to legislate that because of all the unintended consequences. Let's leave it to the business owners and industry that actually know what they're doing and how to do it.
So let's talk about what's going on in Michigan. I'm sure you saw the report about Rep. Slotkin, who's going for the Senate seat. She's telling her donors, according to the scoop from Axios, that she is underwater because Kamala Harris isn't polling well in Michigan. Are you expecting a red wave in your state?
I I don't want to predict a red wave. Last time we did that, it didn't turn out exactly like a red wave. I want to predict a win, right? And I think I'm cautiously optimistic that we are going to get a win in Michigan. And I think we're going to get a win for 3 reasons. And I said them earlier: the economy, the economy, the economy. People in Michigan are hurting. We're a manufacturing state, right? We're an auto state. We need to be able to do business. And with the inflation and the layoffs and the mandates, people in Michigan are hurting, and it's because of the policies that this administration and the Democrats are cramming down our throats.
You said the best thing the government can do is to stay out of your way. You talk about how business really needs to just be left to their own devices. And yet Donald Trump is talking about tariffs, extensive tariffs that could potentially increase inflation and potentially put up gates to the concept of free trade and businesses making those decisions. Why is that a good option?
Well, I think if you look at the tariffs that Donald Trump is proposing, he's proposing tariffs as a reaction to unfair trade practices. What Donald Trump wants and why he's using tariffs as a tool that he has in his tool belt is to make sure that we are playing on a level playing field. Right now, we're not playing on a level playing field. And he wants to make sure that we have a level playing field for our businesses and for American companies. If our adversaries like China would like to play on a level playing field, I don't think there's a need for tariffs. But if they're not going to play fairly, you're doggone right he's going to put tariffs in place, and I agree with him.
I'm curious, just more in the immediate aftermath of the strike, just to sort of go to the next couple of weeks, not just the longer term. We are talking about the biggest strike of dock workers going back to 1977. There are a lot of auto parts that could potentially be coming through. How are you preparing your manufacturers in Michigan for the potential of production being stopped or delayed because of this?
Listen, we're very concerned. And they've been preparing up to this point because they had an inkling that this would happen, right? This isn't something that just happened yesterday, right? We've been able to prepare a little bit, but make no mistake, this will be devastating for Michigan manufacturing, for trucking industries, for grocery stores. But the biggest people who will be affected by this will be the consumer, right? On top of record inflations, the people of Michigan are going to be hurt drastically. Do
you think the White House should get involved?
You know, I think it should have never gotten to this point, right? The White House touts itself as, you know, Mr. Joe Union, right? Why did it get to this point? There's no reason it should have gotten to this point. But again, like many other issues, here we are today, and now we're in a crisis situation. We've got to do better and be more proactive so that we don't get to this position.
This is where we are, though, Congresswoman. So I'm wondering, there is an act that he can activate that would initiate an 80-day cooling-off period. Do you think he should do so?
Yeah, I think you should take a long, hard look at it, right? We have to bring both parties back to the table. It couldn't be a worse timing, right? You have inflation, record high inflation, but also let's not forget about the devastating hurricane.
We had high inflation. It's come down a little bit.
Well,
prices still elevated.
Well, prices are still elevated, but it's the bottom line that counts, provided you know how to count, right? If inflation's at 1.4%, it goes up to 9 and it comes down to 4. 4 is still higher than 1.4.
People are still struggling.
People are still struggling, but also on the backs of the hurricane that we've got to be able to get supplies and the necessary aid. This dock strike is not going to help that at all. So I think we should take a long, hard look at it. Well, you know, and to your point, here we are. Yes, we should have never gotten here, but here we are. So we have to take a look at all of the options to protect the American people.
Well, we appreciate your time. Thanks for being with us here in New York City.
Thank you.
Thank you. Come back again soon. Republican Congresswoman Lisa McClain of Michigan. A lot of issues piling up in this country going into the election.
Yeah, just in case people were concerned that there weren't enough things on the table that could potentially add to the 17 narratives or 5 narratives just in October alone. We have a couple more.
It's going to be an interesting 4 or 5 weeks. Up next on the programme, Bloomberg's Danny Berger outside the Marine Terminal in Elizabeth, New Jersey, as port workers walk off the job. That conversation just around the corner. From New York, this is Bloomberg. Chairman Powell with the headline of the last 24 hours. This is not a committee that feels like it's in a hurry to cut rates quickly. This rally stalled on the S&P 500 kicking off Q4. We're negative by 0.02%, just about positive on the Nasdaq 100, still closing out the month of September for a fifth consecutive monthly gain on the S&P 500. As Lisa indicated, also in the bond market, 5 months of gains. Yields falling for 5 consecutive months. Something we haven't seen on a 10-year maturity going all the way back to 2010. In the bond market right now, switch at the board, we look like this on a 10-year, 374. Lisa, a 2-year, down 2 basis points, 362.
One thing I think will be really interesting to see will be how much the bond market really determines the fate of the stock market. A question here of how much the gains that we've seen, some 20% year to date, really hinge on this idea of an aggressive rate cutting cycle by the Federal Reserve. If this market has priced in too many cuts, as Larry Fink was talking about of BlackRock earlier this morning, do you end up with a market, equity market, that responds badly, or is good news still good news?
So good news might become bad news.
Well, I don't know.
Potentially.
If I say that, we're going to get a call from Stuart Kaiser saying, really, I'm just turning you off and muting you, which is fine. But I just think that is something that I don't want to bring back. But there is a feeling that if yields spike, there could be a reaction that is somewhat more negative in the equity market, like Peter Tchir was saying earlier.
We'll get some news a little bit later, 10 a.m. Eastern time. JOLTS, job openings in America, ISM manufacturing. Look out for those 2 data points. Earlier on this morning, we had some data out of the Eurozone. Check out the euro. Euro dollar negative by 0.4%. It's a break of 111. It's 110.87. CPI below 2% in the Eurozone on a headline rate for the first time in about 3 years. This came from Capital Economics this morning. We now expect the ECB to cut interest rates by 25 basis points at each of its next 4 meetings.
TD Securities is looking to the neutral rate is 2 to 2.5% in the euro region. This has been what we've been waiting for. Why is the ECB not cutting more aggressively than the Federal Reserve, given the fact that inflation is below their target at this point and you're looking at potential negative economic data? It seems like they're moving more slowly, but a lot of people are saying, just wait. Christine Lagarde might say, listen to me, hold my beer.
It's going to be an interesting meeting in the next few weeks for them, that's for sure. Euro dollar 110.86. Under surveillance this morning, more than 100 people are dead across 6 states following the aftermath of Hurricane Helene. AccuWeather raising its estimate of the total damage and economic loss to between 145 billion and 160 billion US dollars. The storm expected to be one of the costliest in US history. President Biden will survey the damage tomorrow.
We're so interesting hearing from Senator Hagerty is that the concern is right now, given how wet all the land is that there is another storm brewing right now. And they want to make sure that they're prepared for in case these states get hit again. It was comforting, though, to hear that he said he's getting everything he needs right now from FEMA and from the federal government.
This has been an interesting moment. We don't want to make this political simply because it is a real humanitarian issue. At the same time, it's being made into a political moment, and you're seeing the congressmen and the governors of a number of these states that were most effective actually say that they have gotten calls from President Biden and that they are getting the help that they need. Curious to see how this gets dovetailed into the election, especially given that some of the hardest hit areas. How do you get those people up and running to vote when they're worried about just getting their homes back in order?
Presidential candidates are always between a rock and a hard place with an issue like this. If they go down there, they're told by some people they're not wanted because they're taking resources away from where they're needed. If they don't go down there, you'll see a line of people on the media every single day on national television saying they haven't gone down there. And this is the dilemma for any campaign right now, a month out from the election.
Which is why when you heard Biden talk about this, he said, when I can go where it won't disrupt the emergency protocol right now, because it's all hands on deck. And that was very clear from Senator Hagerty, how it is all hands on deck right now in Tennessee, whether it's the power companies, whether it's FEMA, whether it's the Red Cross. But when you're a politician, you want to make sure you're there. You want to make sure that you're standing with the people, telling them we have everything you need. But you really don't want to disrupt the work that's going on.
Senator Hagerty of Tennessee seemed really moved by this in the last hour. And we started that conversation. I think he's dead on. I think there's a sense that for a lot of people in this country, they still don't fully understand the gravity of how bad things are on the ground across several states in this country right now.
This is the reason why people keep bringing up Katrina, not because of an immense number of parallels, but because it's the water, it's the flooding. it's sort of the seeping in and the devastation that comes from that. It isn't sort of the drama of a storm whipping through and knocking things down. And it's where it is. It is not in a hurricane path type of zone. Question here will be, how long will this end up being taken to be rebuilt? But also, what kind of political muscle there'll be behind it, given the fact that Congress is currently out of session.
And one of the scariest scenarios Senator Hagerty talked about was that school teacher that doesn't know where some of his children are, but it's potentially not because they're in harm's way. No one has access to broadband. You see some of these reports, don't call 911, just show up. No one has access to even ask for help. There's so many unknowns that we don't know yet.
Some big stories developing in this country, across the nation right now, including this one. Dock workers walking out of major ports along the US East Coast, the beginning of a strike that will likely ripple through the economy just weeks before the presidential election. The affected ports have the combined capacity to handle as much as half of all US trade volumes.
We heard from JP Morgan the estimates of something like $4.5 billion per day the longer this goes on, although it is a sort of different depending on how long it goes on in terms of supply chains actually getting disrupted. I do wonder, and you asked a great question, Annmarie, about inflation and which areas are actually going to see inflationary shocks more significantly. You have to wonder about the auto manufacturers, considering the fact that these directly go into their supply chains at a time where a lot of components still come from overseas.
And Congressman McClain, who's one of those represents one of those industries in Michigan, talking about the fact that they were preparing for this. But if it goes on a lot longer, how much stockpile do they have and how much higher are the prices going to be? President Biden did put out a statement this morning on the dock workers and the strike that he said the president and vice president were briefed on agency assessments that show impacts on consumers are expected to be limited at this time.
At this
time is the critical word there.
Without a doubt. That particular line is doing a lot of heavy lifting for this conversation. You hear estimates of costing the economy anywhere between $3 and $5 billion. Andrew Hollenhorst of Citi was on the programme a little bit earlier this morning, and he made the point that the costs will escalate over time. And we've covered this on this programme through the summer. Some of the trade volume, the volumes coming through US ports, particularly on the West Coast through the summer, was sky high, close to record levels, in anticipation of some of the things that we're talking about this morning. At some point in the next few weeks, the next month, I've got no idea how long this goes on, things start to bite in a much more material way.
In the meantime, this is a time when typically economists are going around and getting economic data to try to put it together to understand where we're going at a time of a complete lack of certainty. And this creates so much difficulty. And this point, I think, is salient, especially because Seema Shah was saying that arguably this is the most important point for markets that are hinged on Fed action, that is increasingly data dependent. And that data is only going to get messier as a result of some of these developments.
So we get September payrolls at the end of this week on Friday. Think about how messy October payrolls will be. We've got a strike at Boeing, strike here, hurricane disruption across this nation in the southeast. This is going to get really messy.
Especially if you talk about 60,000 of, downward revisions that people kind of bake in. I mean, you just put all this together and you talk about trying to operate in a black box and then saying you're data dependent when that data has been increasingly fuzzy and difficult for people to get their hands around. It's the reason why, I guess, Mohamed El-Erian really keeps talking about having some sort of framework and why the idea of a neutral rate will come into the fore that much more. How much momentum did we have coming into this? And just how vulnerable is this economy to some sort of more market downturn or not at a time when people are talking about pretty steep rate cuts?
The estimate on Friday, 150K. I've got no idea what that 150K is actually worth in a grand scheme of things. I want to finish on this story. CVS is reportedly considering a breakup of its businesses. Sources telling us here at Bloomberg the drugstore giant has retained bankers to facilitate a business review and is considering a separation of its retail and insurance businesses. That stock is up by a little more than 2%.
This has been a company that has been affected by a lot of issues. Think about CVS's with the plastic that you've had to unlock when you go to the store, how much Amazon has really eaten its lunch. In August, the company cut its forecast for this year for its earnings for a third straight quarter. They're talking about possibly offsetting some of the insurance costs by spinning that out, given how much the costs are going up. It just raises a question. What does the new retail chain of drugstores look like? You laugh.
Delivery.
No, but I'm serious. What is sort of the model for them? People were talking about the idea of having nurses there to take care of you and to get your shots. I get it. I've done that. Me too. But is that the future, to have sort of an immediate urgent care center? Is it to just basically be a shipping service so that you can just order things and get it online so you don't have to get someone to unlock those shelves.
I'm pleased you got to that point, because that's the point that bugs me. We see all these crime statistics in this country at the moment. It's becoming very, very political. And I just think of the same thing all the time. They're locking up the toothpaste. They're locking up the toothpaste. Come on.
Okay, in fairness, there were a number of retail crime rings that were specifically targeting these stores. And you saw it during the pandemic. It was an actual ring that kept on going after specific retailers. This is more of a systemic type of thing that needs to get weeded out.
And let's just say the shopping experience isn't quite what it was, right?
I mean, it depends. I just get only the items that are not locked up. And so I kind of look around.
What's left?
Is that what's left?
Yeah. Drink.
Cereal.
I was in a Walgreens the other week, and they were locking up the cookies. I'm not even joking. The chocolate was locked up.
Okay, but truth be told, you're not buying the cookies, but they have, like, the drinks.
Just,
are actually still...
Do my channel checks.
Oh, yeah.
Yeah.
Smart water.
Do my
you can
channel
still get your
checks.
smart water. You can still get your, energy drinks.
Seeing our businesses.
Powerade.
Out of earnings season. Don't you do that? Just get my research in.
Oh, yeah. Yeah, man on the street, walking around.
That's what I'm all about.
Walk about economics.
Let's get to a bigger story, far more important. Thousands of dock workers walking off the job at every major port on the eastern Gulf Coast of the United States. The Longshoremen Union and US Maritime Alliance failing to reach a deal by the midnight deadline. Bloomberg's Danny Berger joins us now from Elizabeth, New Jersey. Danny, walk us through what you're seeing or what you're not seeing and what things are going to look like in days and weeks to come.
John, the good news is that talks were happening until the 11th hour, that they were moving off of their demands. Many people, when they first saw that, the Flexport CEO being one of them, with some of the noise being released yesterday, there was an idea that maybe they could come to an agreement. It didn't happen, but progress is being made. For the part of the USMX, that is the representative of the employers here, they say that they are now offering a 50% pay increase. Still, the dock workers here, the ILA, the International Longshoremen's Association, say that that is not enough. Really significantly, though, in what the USMX is offering, not just that 50%, they said in their release that they want to retain the current language around automation and semi-automation. John, that might be one of the biggest sticking points. The longshoremen here want to make sure that there is a ban on further automation, and it seems like the USMX is not moving from that position. The ILA, the union, saying for now, the ball is in your court and you need to meet us where we are.
Danny, when you look at that statement, the fact that they want to retain that automation language, this just feels like this is much bigger than the almost immediate wage gains, but actually what is going to be the future of these ports.
100%. And look, strikes in the U.S., we are no stranger to a strike happening over technology. Think of the Hollywood strike. So much of that had to do with AI and not wanting jobs replaced there. This time around, though, the U.S. ports are behind the rest of the world. If you look at Asian ports and you look at Amsterdam, for example, they are largely automated. The thing, though, is it's not like jobs have disappeared. The jobs have just been moved. So instead of being on the ports, offloading and loading stuff, you just have someone in a remote location. The issue for these East Coast and Gulf Coast ports, though, is that they want protection, not just automation, banning it. They want protection. If the automation comes in, there needs to be some sort of guarantee that there can be upskilling and the proper type of education and help to make sure that these dock workers still have a job as technology advances.
Do we have a sense, Danny, of what's going on with respect to the talks, of who's getting involved, what government officials, how much the company is trying to up the ante to entice workers back to the negotiating table?
There are many government organizations that are taking part in this, Lisa. We had a statement from the White House laying out all different people who are stakeholders getting in here, trying to support and trying to mediate. The Biden administration really is attempting to avoid invoking the Taft-Hartley Act, which calls for an 80-day cooling off period. The union workers themselves said that even if you ask us to come back, we're going to slow down work and we won't do that. So they certainly have the upper hand at this moment. So the Biden administration at the moment just acting as a mediator. The ILA saying that the Biden administration is actually supporting them. They said in their statement that the administration agreed that the corporations here were being too greedy. But again, the only offer we have on the table that we know of is this 50% pay increase from the employers. We don't know where the union has moved off of what they're asking for at this moment. Again, the regional contention was 77%, but they're saying 50% just still isn't good enough for them.
Danny, just physically, what's going on right now with some of the container ships? Are they just being parked off port? Are they being derailed? Are they being stopped in their original origins just before they even take off in anticipation that this is going to take a while to work through?
The picket lines are up, Lisa. They are just parked on the ports. There is no action happening here. There was a lot of anticipation for this. You all mentioned the record numbers coming in through the coast ahead of this, trying to prevent it. And we also had extended hours in places like this, in Elizabeth, New Jersey. Late last night, people were working up until that very deadline. Every day there were extended hours, there were overtime hours being put in. But for now, the work stops. And part of the issue with that isn't just domestically. Of course, it matters how many days. But because the work is stopping, we're going to get to a situation where there are literal ships just parked in the water that are not going anywhere. This is where it turns into being a global problem. 16% of all global ships come at some point through the East and Gulf Coast. So usually they'd come here to New York, they'd offload, and then they'd go back to Asia. What happens if the strike goes on for multiple weeks? That means that ships will be stuck here on the East Coast. They won't go back to the origin. So globally, it just means that there will be less capacity. Of course, if it's just a few days, not a problem, but a few weeks, months, a big problem.
Danny, thank you. Appreciate the coverage. Looking for more from Danny Berger on Bloomberg TV and on Bloomberg Radio. The longer this goes on, the bigger issue it becomes. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. Tesla is dealing with ongoing labor issues in Europe. The EV maker is facing a widening strike in Sweden after a new union stepped in to support a nearly year-long strike by staff in its workshops. The Vision trade union has announced a blockade in sympathy with the IF metal strike against Tesla that began last October. Starting this October 10th, the EV maker will encounter hurdles while servicing its charging network as the strike is likely to persist. Meanwhile, Qatar Airways plans to take a 25% stake in Virgin Australia Airlines. The Gulf carrier plans to acquire the minority stake from Virgin Australia's owners, Bain Capital, once regulators give approval. The move aims to give Qatar Airways better access to a market where just last year it was denied more flights by the government. As for Virgin Australia, it's aiming to challenge Australia's dominant player in the market, Qantas Airways. And in sports, the Detroit Lions took down the Seattle Seahawks thanks to a record-setting perfect performance from quarterback Jared Goff. Goff completed all 18 of his passes in the win, throwing for two touchdowns and just under 300 yards. That performance eclipses the previous record for passes without an incompletion set by Kurt Warner in 2005, who went 10 for 10. Heading into Week 5, only the Kansas City Chiefs and Minnesota Vikings remain undefeated. That's your Bloomberg Brief. John?
Yahara, thank you. As soon as Yahara started talking about that story, I knew what you were going to do.
Yeah.
Where's the Mets story?
Yeah, why are you rigging this with suddenly American football, which now you're in love with, and you're not even going to mention the fact that the Mets are actually in the playoffs and that's actually a really significant, in the wild card position, it's actually a real positive.
It's me rigging this.
You are.
Okay, and the next hour we'll do something about it.
Thank
Okay,
you.
We'll make some changes. Up next on the program, you can't hurry cuts.
This is not a committee that feels like it's in a hurry to cut rates quickly. It's a committee that wants to be guided. Ultimately, we will be guided by the incoming data.
More on the Fed's Supreme Leader up next from New York. This is Bloomberg. A quick check of the price action for you, starting with equities on the S&P 500, shaping up as follows, just a little bit softer as we kick off Q4. We're down about 0.1%. A single name I want to talk about briefly, Apollo Global Management. Some news from them on Investor Day, expecting to generate $10 billion of annual earnings across its asset management and retirement businesses by 2029. We'll be catching up with Mark Rowan, the CEO, tomorrow morning.
You will be catching up with him. I cannot wait to hear what he has to say. Well, given the fact that they are becoming such a real player on the same scale as some of the major banks out there.
Looking forward to that conversation, 7:30 Eastern Time. 20 minutes sitting down with the CEO of Apollo tomorrow morning. Under surveillance this morning, you can't hurry cuts. You just have to wait.
This is not a committee that feels like it's in a hurry to cut rates quickly. It's a committee that wants to be guided. Ultimately, we will be guided by the incoming data. The bulk of the committee was at 75 or 100 basis points, and the votes were on 50, and that would mean 2 more cuts. It wouldn't mean more 50s. Now, of course, that'll depend on the data, but ultimately that's what the baseline is. If the economy performs as expected, then that would mean 2 more cuts this year.
So here's the latest. Chairman Powell suggesting he isn't in a hurry to cut rates quickly as markets await JOLTS and ISM manufacturing numbers at 10 Eastern ahead of Friday's highly anticipated jobs report. Lindsay Rosner of Goldman Sachs writing, in the dots, unemployment and inflation projections were such that it is a low bar to see more cutting. Don't see payrolls as that much of a catalyst. Lindsay joins us for more. Lindsay, good morning. It's good to see you.
Good to see you too. Thank you for having me.
Why don't you see that as a big catalyst this Friday?
Well, I think this Friday, and you were saying it actually earlier, Lisa, that this is the last clean print we're going to get. We're going to have a pretty messy payrolls with Boeing, with dock workers striking. So this one should be pretty clean. And the bar is really, the Fed has told you 4.4%. We were at 4.2% for unemployment. Not seeing that much is going to happen this Friday. Now, on the going forward, I think the next one is going to be really important. So not saying it's a snooze fest on Friday, but don't think it's going to be fireworks.
Well, given, as you said, how messy that data is going to be, how much weight can we put on the next data point going into the Federal Reserve's meeting?
Well, the numbers are going to be real, right? I think it's something like 30,000 for Boeing that are currently in the strike. It's 44,000, I believe, for dock workers. So those are going to be real numbers that are going to affect the data. As we've heard from Powell, he's data dependent. This is actually something that's going on in the economy right now as we deal with monetary policy unwinding. So I don't think it's totally reasonable to say, just look through it. So they'll know where it's coming from, but it's going to be impactful. And this is the stuff they're trying to figure out to get us to have that soft landing. This doesn't feel soft.
I love how everyone goes to songs. John was citing the Supremes. You're citing Billy Joel. I'm moving out. This sort of big question of how much we end up with rate cuts pushing all of the money in money market funds into other asset classes. Do you believe that story, or do you think that there's been a lot made of that, but it really would have to take cut into zero to really get that to happen?
I believe the story. It's just been one that we're waiting to start. We all have kind of the book. We just are waiting for that first page to get going. And really in the past week it has. So we saw in the past week $121 billion move into money market funds. That is the first step after the Fed cuts. That's the playbook from 2020. That's exactly what we're seeing now. The next page, the next chapter, to use the book analogy, is moving out the curve. And why you move out the curve is not only for diversification, but if you like the yields that you saw in T-bills for the past year or so, you're not going to find them in the front end of the curve. You need to keep moving out. So these are exactly the discussions we're having with clients right now.
If you love these yields, then you'd really love these things, which is what, long-term treasuries? Is it stocks? I mean, what's sort of the asset class that is what you are foreseeing to be the biggest beneficiary of that?
Sure. It really is intermediate fixed income. And we think it should be done with an active manager. Just as you're seeing right now, the things that are happening with Boeing, for example, there's a lot of headlines around a lot of companies right now. You need to be able to pick and choose your bonds. And that's only done by an active manager. It's not done by passively sitting in an index.
I don't expect you to name any other companies. You can if you want. Are there certain sectors you're worried about? Is the automakers part of that picture that you want to steer clear of?
We do have some concerns about the automakers. That industry is going through big changes with EVs. So there's certainly something there. Another industry that we're concerned about, or I should say maybe sector broader, is energy. And there has to be a lot of investment for clean transition. Additionally, I think there's a lot going on with the price of oil and what we heard from the Saudis, how that could change going forward. So that seems like an area that we want to stay a little bit away from right now. There are other areas of opportunities. We still like banks, for example. We think that there's good spread there. And what's most interesting specifically in credit for us is the shape of the curve. So we think the front end of the corporate curve is more interesting than the back end. So there's stuff to do.
Just
definitely idiosyncratic
stuff. Can I jump in?
Yes,
Why
please.
the difference between the front end and the long end when it comes to the corporate credit curve?
Yeah, so there are different preferred habitats of investors, which can lead to technicals that are happening. But one thing that's pretty easy to do is just look at percentiles. So look at spread percentiles over the past 10 years. And the front end, now I know these are not like super exciting numbers, but the front end is a 20th percentile of spreads, where the back end is literally at the 0th, if that is even a word.
Right.
So you're finding some value in between the two.
We can make it a word.
Yeah, I think it's great.
Thanks
2025, Merriam Dictionary.
I'll make it happen. Lindsay Rosner of Goldman Sachs. Lindsay, thank you. As always, appreciate it. Up next, Jay Pelosky of TPW, Ben Slupecki of Morningstar, and Neil Dutta of Renmac, alongside Erin Browne of Pimco. From New York, the third hour of Bloomberg Surveillance. Up next.
I'm still bullish on the U.S., though I'm a little concerned at the pace at which we are going ahead.
You should consider broadening your exposure globally.
A lot of the concern that's out there in the market, it's just not being priced in.
The broadening out is going to be still a very gradual one.
I actually think there's tremendous opportunities.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Annmarie Hordern.
I don't think I've ever seen a guest as happy as Jay Pelosky was when he walked into this room. It's like, get long China, the rest of the world, thank you. Wants to wrap up the year already. Still 3 months left. From New York City this morning, good morning as we kick off Q4. Your equity market looks like this on the S&P 500. We're negative by 0.06%, positive the same amount on the Nasdaq 100 on the Russell. We're basically unchanged. It is a snoozy morning. This will not be a snoozy week. Let's get to the week ahead. Later on this morning, some data. ISM manufacturing, job openings in America. Later on this evening, a vice presidential debate. Look out for that. Then on to tomorrow, ADP jobs report. Thursday, claims Friday. Payroll's just around the corner.
Key question really heading into the fourth quarter is how hinged is the rally in risk assets and the broadening out that you saw over the past 5 months on the idea of the Fed cutting really aggressively into year end? In other words, how much does upside surprise kind of figures coming out of the economy end up stymieing or on the margins some of what we've seen in terms of other sectors other than big tech getting a lot of play?
We just caught up with Goldman Sachs Asset Management, Lindsay Rosner, who basically made the point. She didn't want to say it, but I think I'll say it for her, that this Friday could be a snooze, that the following first Friday of the next month could be the really interesting one. So this is the estimate for this Friday, 150K. The previous read, 142. Lisa's mentioned this a few times this morning. Think how messy the October jobs report is going to be. We could have a strike impact, a hurricane impact, the impact that we've had every month over the last year, which is kind of like cut 60K off. This thing could be very messy over the next month.
It's revision on top of revision on top of revision for that next jobs report. And Jonathan, we just don't know what the impact is going to be yet on the economy, which is why everyone says it's going to be messy. I'm still struck by this line by the president this morning. The assessment that impact on consumers are expected to be limited at this time. Still so many questions when it comes to what is going on in the docks.
So Neil Dutta's made the point, and we'll catch up with Neil later on this morning. Neil wrote this yesterday. Why take the chance with inflation resolved? That's Neil's argument.
Well, is it resolved? I mean, ask Mickey Bowman. Not sure. You ask, Torsten Slok over at Apollo. He's still saying what landing? A lot of people are talking about maybe we are underestimating just how much resilience there is in this economy. The bifurcated tales here. And I think that we have to keep going back to that. What is this market's base case for growth, for the neutral rate? How skewed is the average to this idea of people betting on both a reacceleration and a recession and kind of just splitting a difference, but really kind of trying to figure out what the biggest risk really is here?
Vinu, Barclays, base case year end 5,600. Bear case had a 4, bull case had a 6. Spread was this wide. There's 3 months left.
Right. We could get a lot of different narratives in that 3 months, considering the fact that we've got a presidential election, we've got a host of data, and we have a number of other events like the dock worker strike that we need to get resolved. Issue here is how do you really hedge at a time where the risks are bifurcated? And I keep going back to that. Some people would say, don't hedge at all, just buy Chinese stocks, and they would do very well, at least over the past week.
He's about to tell us that in just a moment. Coming up this hour, the lineup looks like this. Jay Pelosky of TPW Investment Management as the S&P 500 notches a 5th month of gains. We'll speak to Ben Slupecki of Morningstar as dog workers begin striking along the US East Coast, and Neil Dutta of Renmac on why he sees 100 basis points of cuts before year end. We begin this hour with stocks on hold as the fourth quarter kicks off. Markets digesting Fed Chair Jay Powell's cue that he's in no hurry to cut rates once again. Jay Pelosky of TPW is bullish. He writes this: what started off as a buy the Fed rate cut boom has morphed into a buy global risk assets boom. If you aren't bullish risk, you're in the wrong business. Jay joins us now for more. Jay, it's good to see you. You're feeling good, eh?
Thanks, John. Yes, happy.
Why do you think this lasts? Why do you think this move is durable?
That's the point, okay?
I think we're at one of those times where it's really elementary, right? This is a time where you don't overthink stuff. It's pretty simple. And in our view, we have a pretty unique confluence of economic, political, and policy actions on a tripolar world basis, so in Europe, Asia, in the Americas, all pointing in the same direction, at a time when there are huge parts of the global cross-asset market that have significant room for appreciation. So you have the economy doing well, no major imbalances, right? Cashed up companies, fully employed consumers around the world. You have policy-wise the Fed and the PBOC cutting rates. You have industrial policy started in China. They now dominate the clean energy space. U.S. respond with the Infrastructure Act, CHIPS Act, et cetera. And then you have now Europe, basically with the Draghi report, saying we got to do what they're doing to be competitive. All right. And now you have political continuity. President Xi has put his imprimatur on the shift in policy in China. Yep. That's big. He stepped up and he made the point. Okay, we have an election in the U.S. Our view, as we've expressed here before, is a Harris win. That establishes policy and political continuity in the United States. And you have the European Commission with a new 5-year term and a new team to implement their structure. So you have economics, you have politics, you have policy, and now you have the markets. Global liquidity is surging, earnings are growing. And again, my point, the big point, the thing that really gets us excited is that huge parts of the global cross-asset market have tremendous room for appreciation. So KWEB, which is the China Tech ETF that we've talked about here before, up 25% in a week. In a week. Is illustrative, not unique. It is an example of many. And here's the case about KWEB. It's gone from 25 to 30. The all-time high is over $100. It has 200% of potential appreciation to get to its all-time high versus U.S. tech stocks, which are at their all-time high. You have the commodity space, which has been in a bear market relative to other assets for years. Allocations are at 7-year lows, according to B of A in their fund manager survey. You have emerging markets. You have small caps. You have cyclicals, you have thematics. If you look at a KWEB chart right up close, it's massively overbought. If you zoom out, as we talked about one of our musings, the title was Zoom Out, Not In. If you zoom out, KWEB has done nothing for 2 years. Nothing. Let's
pick out one wrinkle. Sure. China. Just want to talk about this with you. It's a point that I think will resonate with you. It comes from Peter Tchir of Academy. This time the benefits would accrue much more to China and its companies than to the US and its companies. There was a feeling last week that anything that touches China, any company with sales into China benefits from the boom that's coming out of China if it starts to really gain some traction with the broader economy. Peter's making the point that this is something that will really only benefit Chinese companies. What do you say back to that?
Well, I would say that certainly if you look at commodities, commodities are likely to benefit. If you look at luxury goods, the European luxury goods makers are likely to benefit. But where I would agree with him, and I would kind of say that we've been talking about this for several months, is what we call the two tech stack divide, right? The U.S. is trying to limit China's access to the U.S. tech market. China is turning around and doing the same. And to us, that is, again, why we went into KWEB, because the Chinese tech market is much bigger than the U.S. tech market. It's growing much faster than the U.S. tech market. And the companies that dominate it, Alibaba, Tencent, JD, et cetera, trade at a fraction of the multiples of the U.S. companies. So we like China tech because China is walling it off from the U.S. So in that case, we would agree with Peter, but we were there several months ago.
But Jay, do you see this trickling down to the real economy? I mean, in August, youth unemployment in China reached another record. We're talking about 20%, and that's the data that we know.
Right. No, I think that's a fair point. And again, it's in the price. There's a reason why it's at a 5-year low. The market was at a 5-year low last week. So the pop is like, again, in the 2-week view, it looks tremendous. In the 6-month, 1-year, 3-year view, it doesn't even matter. It barely has even begun. And that's the point. It's elementary. This is a time when you have to just kind of sit back, zoom out, look at the things that are all moving in the same direction, economics, politics, policy, into a market that has tremendous room for appreciation. That combination is very rare. And if you're a global, macro, multi-asset investor, if you're not bullish, you're in the wrong position.
Okay, well, let's zoom into November 5th and say it's not your candidate of choice, which your thesis basically hinges on. What's the market, what's your take then?
Well, it just reinforces, as we've said, the policy continuity in the United States is pretty critical, right? We need to continue to invest. We need to have the industrial public-private partnership to compete in the highlands of the global economy, AI, climate, and conflict. If the Republicans win, I think it's pretty much common knowledge to anybody that pays attention, the policy mix is really negative for the U.S. economy. It's an inflationary policy mix. It's a tariff deficit expansion policy mix. It means the dollar cracks, in our view. Been in print for months. Dollar cracks with the Republican administration, and that just reasserts and leads to the rest of the world outperforming. Again, we are competing in a tripolar world, Europe, Asia, and the Americas. China is making that move in industrial public-private partnership. Europe is going to try and come along behind it. If we go the other way, then money is going to flow out of the United States, most over-owned assets in the world, biggest performers, massive outperformance the last 10 years, into the rest of the world.
But your biggest risk with the Trump presidency is tariffs. But the Biden administration has kept tariffs on Chinese
we're talking,
imports.
come on, Annmarie, we're talking 60% tariffs, 100% tariffs, whatever number,
Potentially,
the former
some of his
president
advisors
throws out.
say that's just going to be used to get the Chinese to the table to have more free trade. They don't view trade right now and what the Chinese are doing, what the Americans are doing, as free and fair.
Well, I would like to say that I came up with this idea, but I did not. It's a former Morgan Stanley colleague, Stephen Jen, who came up with this point, which is that one of the reasons why China has made the moves that it has over the last week or two is to protect against a Trump administration and tariffs. They are recognizing that they're very exposed right now with their domestic economy being weak and consumption being weak, very exposed to the export side.
Yep.
So they are preemptively hedging against what you just described, and by so doing, they are helping folks understand that the upside opportunity here is tremendous. And so globally, if the U.S. elects Trump, and I think that would be strategically very negative for U.S. assets. Again, the most expensive.
Can I jump in? Your argument for Chinese assets, Chinese equities, is based on the idea that China is walling off competition.
In the tech
Why does the
space,
same not apply to US markets? On top of that, they're going to put some fuel into the mix. They'll cut corporate taxes as well. Stephen Jen's making an FX call, as you know.
Yeah.
Stephen's absolutely fantastic. But when it comes to equities, why would you abandon US equities?
Well, I wouldn't necessarily
if you're saying that some of these
them.
companies are going to get less competition and they'll get a corporate tax rate cut?
Yeah, I wouldn't abandon them. I would simply be underweight, and I would shift to overweight the non-US markets, which again are cheap, are under-owned, and have the policy mix that we've already described, without the baggage of massive tariffs and chaos and mass deportations and a labor market that you're talking about, like a little tiny strike that's going to be a big problem. Trump's talking about deporting 20 million people in a fully employed economy. I mean, what's going to happen then? So yeah, I'm happy to give that to somebody else.
Value gaps versus value traps. I just want to finish on that. There's clearly a valuation gap in the likes of the automakers right now relative to the index, and for good reason. Europe's in some trouble with its automakers. If I pile into those names, and many people did last week, is that a value trap?
Well, piling into the European automakers, yeah, that's not what we would be talking about. I mentioned luxury companies, not automakers. And the automakers are getting their lunch handed to them in China by the Chinese because China implemented the industrial policy mix we talked about and they dominate the entire clean energy space. Dominate it. Solar, wind, EVs, batteries, done. So where we would look would be the emerging markets. And this is a great opportunity for me to bring up a point I wanted to make sure I mentioned, which is that you love third-party validation, right? Who doesn't like third-party validation? So John Kovalos of MRA Advisors, who I think is a pretty good technician, a solid guy, I've been watching him for a long time, follow his work. He wrote last week, generational opportunity in emerging market equities. Generational opportunity in emerging markets. So that's not your common everyday type of thing by a technician. That is telling you and reinforcing and giving our view third-party validation that these markets have tremendous upside.
Yep.
And the US market is fully priced for a very good upside, for a very good outcome. If that outcome doesn't manifest, what is going to happen to that valuation? It's going to get discounted, while the rest of the world kind of plays into the upside that's available. So weak dollar, strong commodities, non-US equities, emerging markets. I mean, there's a tremendous amount of opportunities that people really haven't talked about for years, right? We've all been talking about US tech for years and years
and
years.
You've been miserable. I know every time.
No, I've been happy. I mean, we're in the semis. We're big believers in AI. We're fully invested in the semi space, but we like cyclicals. We like emerging markets. We like commodities, very overweight commodities, and we are very underweight bonds. We've talked about it here. We have had no U.S. Treasury exposure, for the last 2 years. The last couple months, that was painful, but
now you're feeling good.
Now I'm feeling good.
Good to see that smile. Jay, thank you. Jay Pelosky at TPW Investment Management. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hacker. Say, Yahara.
Hi, John. The death toll from Hurricane Helene continues to rise. More than 100 people are now dead across 6 states in the U.S. South. Most of the victims died due to flooding. According to AccuWeather, the economic loss from the storm could be up to $160 billion, making it one of the most destructive storms on record. President Joe Biden says he'll tour North Carolina by air tomorrow morning. Meanwhile, NATO has a new leader. Former Dutch Prime Minister Mark Rutte has taken the reins as the alliance's 14th Secretary General. Rutte told reporters earlier today that he'll continue to press allies to maintain their support for Ukraine and spend more on defense. Plus, he's not worried about the outcome of the U.S. presidential election, saying he will be able to work with either Donald Trump or Kamala Harris. And this one's just for you, Lisa. The Mets and Braves are both headed to the playoffs after an exciting doubleheader. The Mets made a thrilling comeback to beat the Braves in Game 1 yesterday, while the Braves celebrated a victory in Game 2. The Mets will now face off against the Milwaukee Brewers in the wild card round, and the Braves are going to San Diego. That's your Bloomberg Brief. John?
Yahara, thank you. Thank you very much. TV magic. There you go.
Thank
Happier?
you. I appreciate that. That was good.
All right.
I like the Mets.
Okay. I can tell.
Okay.
You're happy too. It's good.
Good.
All right. Up next, the morning calls, plus Ben Slupecki of Morningstar. As dog workers go on strike, the latest for that industry up next. The open about 1 hour and 10 minutes away. Equities covered into that just a little bit softer, basically unchanged throughout this morning. We're down by 0.06%. Let's get you some morning calls. First up, Citi downgrading HP to neutral, citing a cautious view of the PC recovery in the second half of this year. That stock is down by almost 2%. Next up, Barclays keeping its underweight rating on shares of Apple, warning that recent channel checks point to weakening iPhone demand. That stock down another 1.4%. And finally, Goldman upgrading forward to buy, expecting its growing software and services mix to boost margins. That stock up in the pre-market by a little more than 2%. From autos to shipping, ports grinding to a halt along the East Coast as dock workers launch their first strike in nearly 50 years. Global shipping giants bracing for the brunt of the impact. Ben Slupecki of Morningstar has a sell rating on shares of Hapag-Lloyd and a hold on Maersk. And Ben joins us now for more. Ben, can we just start with a very simple question? For the companies under your coverage right now, is this business lost or business just delayed?
It's business delayed for now. The shipping is going to be rerouted, at least in the short term. And as you mentioned, even if, as many of you have mentioned before, even with a week or two delays, that can have effects on the shipping industry for 6 weeks is one estimate for Maersk, but other estimates are 3 or 4 months. So it's likely to be delayed in our opinion, but where business loss might come in the future is if the strike continues for 2 to 3 weeks and continues on in perpetuity there. That's when the risk really begins to increase for business loss, shipments maybe not making it for Christmas, those sort of second, third order effects.
Ben, we've talked a number of times on this programme about the sheer volume, the high volumes going through ports through the summer, largely in anticipation of this and for other reasons as well. Ben, how much of a bump did they get ahead of this, the companies that you cover?
Yeah, it's hard to say how much of the bump early in the summer was in anticipation of this. A lot of it had to do with the disruptions in the Red Sea and delays associated with having to reroute around the Cape of Good Hope. And some of the bigger companies that had the means to get ahead of this got ahead for that reason, also in anticipation of this. So I think that much of this has been avoided. Even in standard years, the heaviest shipping for the Christmas, for the December boom, it would be finished by now. So I would expect that many of the larger firms, the majority of the economy, has prepared for this disruption. And again, as I mentioned, even a prior year, a lot of the Christmas inventories would already be there and already be accounted for.
But I'm curious, longer term, whether this allows shippers to increase their costs on a structural basis, just to ensure against some of the disruptions that we've seen. Not just the strikes, also the attacks in the Red Sea. Just a real question here about how to bake in a higher profit margin to gird against such events.
Yeah, short term, they're trying to mitigate some of those costs with surcharges, but long term, I don't really see them being able to bake that in. The industry already does as much as they can to try and scrounge out whatever margins they can, whether that be joining alliances to kind of come together to share their resources, or whether that be through new models. And Maersk and Hapag-Lloyd in their recent alliance are trying to hub and spoke model, trying to more efficiently manage their ports. But that being said, this is the freight container prices are commoditized, and it would be difficult even in the long run to, I think, really change the structure of that industry and to really bolster margins further.
Which shipping company right now, Ben, do you think has the biggest advantage, either coming into or coming out of any potential disruption?
I wouldn't say any. They're all kind of impacted in similar ways. Hapag-Lloyd has an opportunity to benefit the most, given that they are, or benefit a good deal, given that they're more of a pure play ocean shipper. If rates are to increase, which I would anticipate that they would, that would be a big tailwind for them. The reason for our sell rating is based on just Morningstar's methodology, that we are very long-term in focus, and Hapag-Lloyd's shares often do trade with the trends of the container index. So if you're looking for something short-term, there is potential that they could rise with some of the more temporary increases in rates that would be seen if there is a supply disruption as a result of these delays or as a result of the strike. But other than that, it's kind of an equal opportunity industry.
Big sector to watch. Ben, appreciate your time, sir. Thank you. Ben Slupecki there of Morningstar. The base case at the moment, it can change depending on how long this goes on. But the base case at the moment, in the near term, it is business delayed, not business lost. But on many occasions this morning, we've had this conversation. The longer this goes on, a number of weeks, the worse this gets. Especially given the fact that you have to imagine you need other channels and you have produce, save the bananas. And the apples as well.
Well, yeah, but there are a lot of apples.
Not as dependent on imported apples. There
exactly.
we go.
And in New York State, we've got a lot of apples. Go apple picking, it's the fall.
OK. Maersk and Hapag-Lloyd getting hit this morning. Guy Johnson said to me a long time ago, Maersk needs a stock split. And I totally agree. Have you seen the price of that thing?
Yeah, it's way too high.
That I agree on. From New York, this is Bloomberg. "60 minutes out from the cash open, your opening bell just around the corner. Equity futures on the S&P 500 negative by not even 0.1%, coming off the back of 5 consecutive months of gains, 4 consecutive quarterly gains. First time we've seen that in quite a while. 1 hour away from the opening bell with your morning movers. Let's get to Manus Cranny. Morning, Manus.
Jonathan, a very good morning to you. The Journal leads with a story on Boeing that they may go for a capital raise of $10 billion. Now, it's not a done deal. So if you think about the headwinds for Boeing, you've got 33,000 workers on strike. You're quite literally burning a hole in your pocket. Every month that this strike endures is $1.5 billion. So do you fill the gap with the $10 billion equity raise? We're on the cusp of going to junk. TD Cowen have a note out this morning. They say $200 is still their target. They can sell assets. And they still have a bullish call on free cash flow and delivery going through to 2025, 2027. So we'll see how this capital story comes out. CVS, they're at the gate. Activist players are at the gate. Glenview Capital is baying for changes, if not a breakup within CVS. They're going to do a strategic review. That's the red headline. You've got a tough retail environment and an insurance business that is under pressure. Larry Robbins has a $700 million stake in this business. Deutsche Bank, great line here. Breakup reports are a smell of desperation, poor execution, and trying to salvage value. Have a look at Zim. You've talked about the banana shortage, the risk of it, but this is an Israeli company domiciled in Haifa, quoted in New York. As these port strikes build, you are just seeing a real pressure. You talked about Hapsag. This is Zim, 45,000 port workers on strike. And the issue is, of course, bananas. Port Wilmington. Nearly 25% of the US bananas come through Port Wilmington. The bananas, Jonathan.
Manus Cranny, thank you. Lisa's all over this story in a way that I have to say was unexpected. Big deal for you.
It's actually fascinating because there actually have been stories written about our banana intake and how it's only one particular type of banana.
Okay.
And there could be a shortage. And so this is the reason why it matters.
Banana-gate.
Well, and people depend on bananas for their breakfast, and I'm just looking out for them.
People like you.
Just theoretically.
Yeah, okay. Markets digesting Fed Chair Jay Powell's message that he's in no hurry to move ahead with more rate cuts. But Neil Dutta of Renmark sees 100 more basis points of easing before year end, citing the fact that unemployment is likely to continue rising and inflation continues to slow. Neil joins us now for more. Neil, welcome to the programme, buddy, as always. I was reading the note yesterday. Just one very short line, I think, captured everything. Why take the chance with inflation resolved? Neil, can you answer your own question?
Well, I think when I look ahead, I do think there's additional upward pressure here on the unemployment rate. I mean, if you look at what consumers are telling you about the jobs market, it's not like they're telling you that things are getting better. It's not even like they're telling you that things are stabilizing. So the distribution of risks with respect to the labor market are clearly skewed to the downside still, even after this 50 basis point move. I mean, there is some inertia in the labor market data. And so the fact that things have been weak is probably a good reason why they'll stay that way. But if you look at the Conference Board labor differential for example, it's clearly telling you that that the unemployment rate probably keeps going up. How much up, I think remains to be seen, but I do think it's probably still higher. And at the same time, core inflation has been running below 2% since May, and that's happened despite very little help from housing rental inflation. Now, I think that there's probably still additional downside with respect to rents, based on what we see with things like new leases and new tenant rents, for example. But if rents begin to cooperate, then you can see continued downward pressure on inflation. So, my sense is that, the Fed's forecasts are conditional. And, it's interesting to see Powell kind of toe the party line after basically exerting his will in September. But my sense is if you get a clunker on the employment report between now and the November meeting, I think he'll have the ammunition that he needs to push through another 50 basis point rate cut.
And Neil, as you said, the chairman yesterday sounded somewhat confident off the back of recent data, as you indicated in your note earlier on today, reiterating the Fed's baseline. And as you've alluded to, where you think that baseline is vulnerable is when it comes to unemployment and the labour market. Can we just push ahead to Friday? What kind of numbers do you think we need to see to enable Chairman Powell to really assert some authority again on the committee and get him to go another 50?
Well, let's be clear. I mean, if you look at the 3-month trend in private payroll employment, it's already running below 100,000. So, I think it's possible with those kinds of numbers, particularly with, we've seen state and local governments kind of slow down a little bit. I do think it's possible that you get additional upward pressure on the unemployment rate. And then when you look forward to the October jobs number, I mean, there's just a lot of just potential hits that report's going to take. I mean, you have the Boeing strike, you have obviously the port strike, and then you have this natural disaster, Hurricane Helene, that's displacing a lot of workers at a very sensitive time for that area. I mean, if you know Asheville, I mean, their tourism industry revolves around the fall season, right? So, I think you can't rule out a really, really bad number going into that. And again, does Powell want to get up there after a really weak number at the November press conference and look at the cameras and explain away the jobs number based on special factors at a time when they may well be revising down their expectations of inflation?
Neil, key question here. A lot of people pushing back pretty aggressively against the fact that the economy is slowing down really substantially. Torsten Slok, where is the slowdown? A lot of people pointing to Atlanta Fed's GDP now, which points to 3.1% growth in the third quarter. How does that cohere with what you're seeing, especially at a time where we're not seeing an increase in jobless claims and a lot of the other potential ancillary kinds of information are not pointing to that real negative downdraft?
I mean, if things are so strong, why is the unemployment rate up? It's a pretty simple. I mean, I thought it was very interesting that Powell talked about, GDP and GDI revisions, and admittedly, they've been positive. But one thing that's not really revised is the unemployment rate, and the unemployment rate's been climbing. And I would just point out that the unemployment rate has been rising despite this seemingly strong economy. And consumer attitudes about the labor market have been getting worse despite strong headlines on GDP. So, if you take that all at face value, it basically means that the economy is not growing below potential, is growing below potential. And Powell admitted that, look, I mean, growth may not be strong enough to keep the unemployment rate from rising. If that's the case, that means that the labor markets are exerting downward pressure on the wages of those that are already working, which is disinflationary. So that's another reason for the Fed to be easing.
Neil, I'm not disagreeing or agreeing because ultimately we cannot know. What I find really interesting, and I mean this sincerely, is the conviction and the idea to have the conviction to say to cut by 100 basis points at a time where there is a huge debate over whether we could see a reacceleration of the impact of, say, some of these strikes on data, making it really messy at the same time that it's potentially inflationary, at the same time that we're on the cusp of potentially inflationary policies that could get implemented in the United States early next year. How easy is it for you to have conviction at a time where there seems to be really bifurcated tail risks?
Well, I mean, I think that every outlook is fraught with uncertainty, but I certainly don't believe the Fed should be front-running potential fiscal outcomes based on, and applying that to today's reaction function. I mean, this is about the data as it's been coming in. Look, I mean, conviction, I mean, I guess this is sort of tongue-in-cheek, but I'm paid to have an opinion, and I'm paid to kind of give people a coherent view of the world that I think ultimately will pay dividends for them. And so, I think that's part of where the conviction comes from. But for me, it's really about what are the markets pricing in, and where do I think the distribution of risks are? And to me, right now, I think the idea that the Fed's just going to deliver 2 25 basis point rate cuts, I think is a problem, because that is conditional on a forecast that assumes, the unemployment rate's at 4.4% by year end, and that you see 2.6% core inflation year over year. If you get inflation prints like you did over the last few months, they'll be revising down those estimates for core PCE. And we're at 4.2% unemployment. And the things that I see, whether that be job openings coming down, whether that be hiring rates remaining weak, whether that be the Conference Board labor differential. All of those things kind of nudge me in the direction to say that we may be at 4.4% before year end. And like the Fed's forecasts are conditional. So to me, it's not an especially big leap. So if I'm looking at the way the markets are priced, I think it makes sense to bet that they'll end up doing a little bit more than what's priced into the forward curve.
One thing we can all agree on, November 7th, box office. Neil Dutta of RenMac. Neil, thank you. There are going to be so many issues on the Fed's table that week.
How do they grapple with that? I mean, actually, Neil raised a really important point, which is Fed Chair Jay Powell going to get up there and say, all right, this is the number, whipping out the PowerPoint. This is what we got to take out because of this. This is what we got to take out because of this. Guess what? We just had an election. We may or may not know who is sort of elected. We can't really consider that. So just ignore that. But in the meantime, over here, how does he deal with this?
Imagine the Q&A. Erin Browne of Pimco joins us around the table here in New York. Erin, good morning.
Good morning.
Let's explore that just a little bit more. Never mind this jobs report. The next one, hurricane effect, port strikes, Boeing strikes, the election, all of that. When you look at the data right now, how much of it is just holding back, waiting for some of these issues to be resolved, and how much of it is really about a cyclical slowdown in the economy?
So I think a lot of it is driven by companies just holding back and waiting for more clarity, policy clarity, the outcome of the election before they go forth and, continue CapEx investment. And what you've seen is historically over time, you do see this cyclical low going into recessions. And so what we're seeing right now is not different than what we typically see going into recessions. Now, there's heightened policy uncertainty this time around. The Atlanta Fed yesterday released a report, or over the weekend released a report, suggesting that the majority of companies right now are holding back either hiring spend, CapEx spend, and really waiting for more clarity. We're likely to see that start to be spent again once we get past the November election. But, that certainly policy could change that. And so while we're not expecting a significant slowdown now, we do think you're coming into a third quarter lull, which hopefully we'll see a bounce back into the fourth quarter.
Will we juice that bounce back? Because the argument that Neil's making, by the time you get to November 7th, Chairman Powell won't be in a position to sit there and make a long list of excuses. Neil thinks they'll cut 50 basis points. Where are you on that?
I mean, Chair Powell pushed back against that yesterday, and we're in the camp that they'll likely continue to go at a 25 basis point cut pace from here on out over the next 5 or so meetings, really getting to a total of about 150 basis points before they really stop, digest, and pause and wait to see how the data is responding in response to the cuts. That's not to say if we were to see a much steeper slowdown than what we're anticipating, you certainly could get a steeper rate of cuts. But right now, with the data at hand, with the inflation coming down but at a slow pace, and with the Fed really wanting to be patient and not overreact, I think that they'll likely go from a 25 basis point cut from here on out.
How much does it matter, the pace at which they cut rates for risk assets?
I think it matters from a signaling perspective more than anything. And signaling both ways. If the Fed starts cutting more aggressively, the market could get concerned and say, what is the Fed seeing that we're not seeing? So I think from a signaling perspective, it's really important. In terms of the destination probably doesn't change. They'll just get there faster. But I think that what matters right now for the markets is how quickly they're cutting relative to other central banks, and whether they're cutting faster than the market's anticipating. And I think right now the market's anticipating a little bit faster than 25 basis points per meeting, but not 50 basis points per meeting. When you look at over the next 2 meetings, the market's pricing in about 69 basis points of cuts.
When you look at the balance of risks right now, what do you think has been the most overpriced risk, and what do you think has been the most underpriced risk? We were talking earlier about Max Kettner saying everyone wonders what's going to be that downside. And he said, actually, no one's asking me about a rip-roaring rally further from here. Are you kind of on the same page with that?
To some extent. I mean, the market, though, is trading at all-time highs. It closed at all-time highs yesterday. So, yes, the market hasn't been anticipating this rip-roaring rally, but it's been trading, well in response to heightened concerns generally over the market. And so I think that continues to be, sort of even if the market isn't talking about it, that continues to be the path, or the easiest path forward. It's just higher market prices. I think right now, I mean, certainly China over the last week has taken the market by surprise. That was certainly an underpriced risk. So if I'm, really talking about what's mispriced or what was not expected by the market, China is, front and center right now.
But you still think China is a trade, not an investment. What would make you want to change that and be a settler, not a traveler?
Yeah, absolutely. So I think that the fiscal policy put in place thus far isn't enough to overcome a lot of the structural problems that exist in China. And so you would need to see much more significant fiscal stimulus, really leaning into some of the steps that they took in prior years, like 2016, in order to get really comfortable that this is a change, a step function change in the way that China is going to be addressing its policy going forward, particularly around the housing market. We really haven't seen that yet. We've seen a lot of headlines, but not a lot of detail under the headlines, which would make me comfortable buying this as a long-term investment.
There was this theory that China was potentially waiting for the outcome of the U.S. election, like some of the businesses you were pointing to. Do you think we could see more down the pipeline from the PBOC and the Politburo?
I mean, I think that there's been a lot of hope certainly over the last year, that you would see a lot more detail and that, that there wouldn't be these false starts, and we haven't yet seen them. So I'm going to be waiting to see much more credible policy push coming out before I get really comfortable buying this longer term. Right now, I think it's easy to put out headlines, but when you really get into the nitty-gritty and actually making sure that this policy really filters through all segments of local government, central government and company action, we haven't yet seen that.
We're through 3/4 of the year. We still have a quarter left. We've got lots of narratives that potentially could come to the fore. I'm just wondering how much of the broadening out that we've seen in the previous quarter you see really sticking. This idea that people can continue to move away from AI and see outsized gains from the equal weight or the Russell 2000.
I think that trend is here to stay. I mean, we have seen now corporate earnings profitability inflect for the broader S&P, 500, for the 493 companies outside of the Magnificent Seven. And I think that has all been followed with price action as well. So it is fundamentals that's leading this broadening out. And I think that the fundamentals can continue, particularly if we have at least a fairly benign environment for risk-taking, still positive economic growth, and lower inflation, which is all, the macro environment that we're anticipating.
Do you think bond yields should be higher?
From here, I think right now you're probably close to fair value over the short term. Over the longer term, I still think that bond yields move lower as the Fed continues its rate cutting cycle. But we've seen a lot of that pulled forward over the last 6 months or so. So I think right now we're trading close to fair value. But if for a longer term, medium term investor, I think, bonds are still a really good investment.
Erin Browne of Pimco. Erin, appreciate your time. As always, thank you. I want to take the opportunity to get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. Israel is beginning targeted ground raids into southern Lebanon. The Israel Defense Forces saying it's striking targets located in villages close to the border that it says pose an immediate threat to Israeli communities in northern Israel. The attacks further expand the campaign against the Iran-backed organization following Israel's killing of its leader, Hassan Nasrallah, on Friday. The U.S., the European Union, and Arab powers are all calling for a ceasefire. Meanwhile, President Jimmy Carter is celebrating his 100th birthday today, making him the first American president to live a full century. Carter served one term from 1977 to 1981 and then worked more than 4 decades leading the Carter Center, which he and his wife Rosalind co-founded. Carter has been living the last 19 months in hospice care in his hometown of Plains, Georgia. And last month, his grandson said the former president said, quote, "I'm only trying to make it to vote for Kamala Harris." And private equity giant Apollo expects to generate $10 billion of annual earnings by 2029. The company saying at its annual investor day that it expects profits to be driven by investor demand for private credit and annuities. By 2029, it also expects its assets under management to grow to $1.5 trillion. Our own Jonathan Ferro will sit down with Apollo CEO Mark Rowan at his offices at 7:30 a.m. Eastern tomorrow. That's your Bloomberg Brief. John?
Yahara, thank you. Looking forward to this. Changes on how companies are financed, the companies that need the financing and the future of investing worldwide. That conversation tomorrow morning, 7:30 Eastern Time. Up next on the program, we'll set you up for the day ahead from New York City this morning. Good morning. Q4 about to begin. The opening bell 38 minutes away. Counting you down to that cash open, your trading diary the week away looks like this. The week ahead, rather. We'll get Jolts and ISM Manufacturing at 10 a.m. Eastern Time, ahead of Nike earnings after the closing bell. At 9 p.m. Eastern, the first vice presidential debate. Wednesday, we'll get ADP private payrolls. Thursday, another round of jobless claims. And on Friday, the main event, September payrolls report. Bloomberg's Danny Berger's back with us now as dock workers go on strike along the U.S. East and Gulf Coast for the first time since 1977. Danny, walk us through how expensive this could get. It's been a big theme of our program so far this morning.
It could get very expensive, John. Now, there are a lot of estimates out there. I'll just point to one from JP Morgan. The highest end of their estimate is per day $4.5 billion. The issue at stake here is that it's not just one day. For every single day that a ship is just waiting in the wings and can't offload during the strike, the estimates are that it will take anywhere between 6 to 10 days to offload. That means if it is a month, it will likely take 6 months to 10 months to offload. So that just means the economic cost of this will continue to build up with the longer it goes on. Now, to specific industry, a lot of raw materials are going to be affected. Tobacco, 78% comes through the ports. It's a little bit less for autos, something like 30%. And they also have the benefit that there's less demand, so inventories are high. But again, it goes on long enough, there is an issue. Perhaps the biggest consequence will be to small businesses. And this is a ramification that's going to last even beyond when the strike is over. That's because when the strike is over, the businesses that will be prioritized are those with large orders that have spent a lot of money. That is the large businesses. They can also afford to do air freights. So when we're talking about economic damage, it's really the small businesses we need to pay attention to.
Danny, the White House came out with a statement today saying that the impacts are expected to be limited at this time. Really key there, at this time, because the longer this goes, how damaging this is going to be, not to the economy, but also to the politics. Where are we right now with the White House getting involved in these negotiations?
Well, the White House has tasked a number of people and say that they are in direct contact with both the employer, that is the USMX, as well as the International Longshoremen's Association. We know Lael Brainard, the National Economic Advisor, Pete Buttigieg, Secretary of Transportation, Julie Su, the Acting Labor Secretary, and the Chief of Staff, Jeff Sines, have all been in direct contact with both. The Biden administration is trying to avoid enacting the Taft-Hartley Act, which would require an 80-day cooling off period, which would mean people would have to go back to work. That is a lose for them. They don't want to look poorly to the unions by doing that. So that's why they are having this in the background negotiation. The ILA said that the White House really was encouraging them to have talks until the 11th hour, until the strike happened. The ILA also saying that the White House supported them, that they agreed that the employers were being too greedy. Now, obviously, the White House has not said that. So at the moment, they're not directly intervening. It's a lot of behind the scenes negotiation and mediating. But the longer this goes on, the more painful it will be for the Biden administration and for Kamala Harris as she attempts to run for the presidency to have the sorts of headlines of the economic damage that could unfold.
Danny, appreciate this morning. Looking forward to the coverage through the day and perhaps even through the next few weeks. Bloomberg's Danny Berger on the latest there. Browne, I think the word of the morning, mess. And how messy this month could be.
And how messy the ramifications could be for the economic data. This just for people who are trying to be data dependent, including the Federal Reserve, it creates some challenges to really understand what's noise, what's signal.
Yeah, potentially some major challenges. Coming up tomorrow, here's the lineup for you. All-star lineup, Jim Bianco of Bianco Research, Wei Li of BlackRock, Mark Rowan of Apollo, Kristen Bidley of Citi. From New York City this morning as we kick off Q4. Good morning. This was Bloomberg Surveillance.